We would like to be almost on time, almost, about. Okay, so thanks. Have a seat, please. Thanks so much. And so in this afternoon, we begin with sustainability disclosures and integration in reporting, the regulatory views. This morning we always spoke about that, but now we have a moderator, Jonathan Lebry, Chief Connectivity the Integrated Reporting Officer of IFRS Foundation. Thanks so much, Jonathan, while the panelists are Vania Borgert, Deputy Coordinator of International Relations at CBS, the Brazilian Committee for Sustainability Pronouncements, and the board member of the IESBA, Guglielmina Onofri, Head of the Italian Stock Exchange Regulator Issuers Information Division, but now she has stepped up to be Secretary General of the Board. Congrats, Guglielmina. And Roberta Ravelli, Technical Support Office of ISSB Vice Chair, IFRS Foundation, and Christelle Richer, Associate Professor at the SEC Business School, International Audit and Assurance Standard Board, member, Autorité des Normes Comptables, member. This is for Jonathan. Thanks so much.
Thank you so much, Alessandro, and good afternoon, everybody. I hope that everyone had an enjoyable and delicious lunch and that it was invigorating for this conversation about the role of regulation and the regulatory perspective on the conversations that we've been having so far today on sustainability and integration in reporting. It's a great pleasure to have such a distinguished panel, and we're going to begin by thinking about why integration in reporting is actually important in the first place. We've talked about some of the principles today, we've talked about some of the practice, but let's get into the heart of why is this such an important perspective, particularly from a regulatory standpoint. Also, we're going to understand a little bit more about what is happening globally. How are regulators responding to this need for a greater focus on an integrated package of information for the capital markets? And we're going to hear a global perspective. We're going to hear from Italy and the European Union. We're going to hear from Brazil. And we're going to get a global perspective from Roberta from the IFRS Foundation, who's been working with jurisdictions around the world. And then finally, when we think about a reliable package of information for the capital markets, we of course cannot exclude, and we've already heard today from practitioners, from Mark and from Veronica, about the importance of assurance. And so we're delighted to have an ASB board member, Christelle, here with us to provide a real sense of where the global assurance standard setter is coming from in this debate. So perhaps, Roberta, I could start with you. Perhaps just putting this conversation into its broader context, and also from an IFRS Foundation perspective, why is integration in reporting so important? And also, what is the Foundation doing to address the jigsaw of disclosures, and how the different elements of the ecosystem, how do they contribute to a more integrated package of disclosures for the capital markets? Thanks, Roberta.
Well, thank you very much, Jonathan. And I'm going probably to repeat part of the concept that have been already mentioned this morning, but just to put into context. So we mentioned several times this morning IFRS 1 and IFRS 2, and one of the reasons for which the ISSB has developed IFRS 1 and IFRS 2 is to reduce the fragmented landscape of sustainability reporting, which include both voluntary standard, but also a growing number of requirements in different jurisdictions that of course have cost, complexity, and risk for both companies and investors. And this is something that the IFRS Foundation noted when we did the analysis of the effect of new standard, because each time that we publish a new IFRS standard, we assess what are the likely effect of introducing new requirement. And what we did for sustainability, the sustainability standard, was to assess the current landscape of sustainability reporting, seeing that many companies already disclose on a voluntary basis, but the development of the standard was intended to create a more robust set of requirement, so that can be assured and also enforced by the regulators. So the ISSB role is, I would say, clearing, developing and establishing the global baseline, but the ISSB is not alone in this journey, and I think that this panel very well represent all the parties that are involved. When the ISSB has issued IFRS S1 and IFRS S2, IOSCO has immediately started a process to assess the standard and whether they were fit for use in the different jurisdictions. And actually that was a very important step because the endorsement from IOSCO has, we'll say, given the green light to regulators to start to assess whether it was the time to move from a set of voluntary framework and standard to something more robust, introducing requirements. And that happened only last year, but we have seen already a very large number of jurisdictions taking steps in introducing the requirement. I said the ISSB is not alone in this journey, so we have, of course, the IOSCO, the security regulators, but also all the audit standard setters that have the important role of developing the assurance requirement, the ethics requirement, the independence, and on that I think that both Christelle and Vanya would be better placed to comment, to prepare, I would say, the territory for regulators in the confidence that a better system of information can be enforced and then create the, I would say, discipline. I think that both Veronica and Mark earlier talked about the important role of assurance on I would say, creating the territory for regulators. So I see integration in this context as putting all the different parties together to really achieve what is a common objective of having global comparability information on sustainability for the benefit of investors, but also for other parties.
That's great. That's a brilliant oversight, really, of the role of the foundation in bringing together all the different parties of the ecosystem, and then having IOSCO, as the global organization for securities regulators, actually endorse the standards, which then creates that pathway for jurisdictions to adopt. So Vanya, building on Roberta's introduction, and before we go specifically to Brazil, I just wondered from your perspective if you could explain what role regulators in the different markets, what role they play in fostering the conditions for greater integration in reporting and creating this more compelling and package of disclosures for the capital markets. Thank you.
Thank you for the question, Jonathan. It's a pleasure to be here and sharing this with you because, as Roberta mentioned, we used to have very good ideas in connection to reporting sustainability. The problem is that they were, in the great majority of circumstances, a report or explain basis. And that will mean that each company will elect its framework, elect the way they will be reporting. And the end result of that was that we have no comparability at all between companies from the same sector because one was reporting sustainability using a basis and another one. And the importance of having a regulator is to define a baseline for reporting, under which every company will be following, and so then we can end up with robust conclusions when we analyze a report and then we can make the decision-making process equally robust. So I understand that from the beginning I was in favor of having integrated reporting, because I was involved with integrated reporting since 2011, regulator, where there are some number of the members of the council that were in favor of keeping it voluntary without time limit. And I understand that the regulation is a very necessary step. I'm an accountant, and I love accountancy. I'm not involved with sustainability reporting because I'm fed up with accountancy. I love it. And I understand that integrated reporting gave me the perception that financial reporting was no longer enough. We need to know more in order to provide useful information for the market. And integrated reporting was the solution I found for doing that. When IFRS Foundation embraced the responsibility of standardizing sustainability report, it was a dream come true for us accountants in Brazil. Because if you want an integrated reporting at the end of the day, who better to standardize it than the same institution that is already in charge of doing the same thing for the accountancy? The chance that we have of really ending up with an integrated reporting is bigger. I heard this morning some panelists mentioning integrated reporting and implementation of IFRS S1 and S2 as two separate things. In Brazil, we saw it as a natural path ahead. So we already have integrated reporting very well structured that. Then IFRS S1, in our perception, is the additional guidance for us to have the transparency, the content of the reporting being presented in a very natural way. That's how we are treating this in Brazil, not as a different report, but as a natural consequence of already being using integrated reporting. I think that will make it easier for us to implement IFRS S1 and 2.
That's great, Vanya, and I think that whole concept of this being a natural kind of pathway and thinking about this as an evolution and how we kind of build on this rather than creating false choices in the system, I think it's a really interesting model that has been developed in Brazil. So Guglielmina, if I could come to you, please. So as the stock exchange regulator here in Italy, what do you see as the potential risks of a fragmented disclosure system? And how are you working to encourage a more cohesive system of reporting in your role in Italy?
Okay, first of all, I would like to, I am very happy to be here. This is a very important conference, and it's a pleasure to be here today. So regarding your questions, so disclosure is fundamental to the functioning of the capital market. As a security regulator, for us it's extremely important to address the risks posed by fragmented disclosure. Fragmentation could lead to increased costs by dissemination of information, and this could put some concern about a retail investor who may don't have sufficient resources in order to gather and analyze the information. So for us, it's a very important aspect. This could lead also to undermine market efficiency by delaying the dissemination of important information, and could have also an impact on the price of the security. As investor, pricing all the information available to make an assessment on the company value, so they have to consider all the information, included also the non-financial information or sustainability information. However, there is some evidence that the non-financial information currently published by the company were not always consistent or exhaustive. Sustainability information can be hard to compare from companies to companies, sometimes appear not being inconsistent with the other information disclosed to the market. So this is one of the reasons that, in line with the CSRD, the European Commission has adopted mandatory, robust, and comparable standard for the new sustainability requirement. So this is an important aspect because the standardization and the comparability of the information is one of the most important aspects for the disclosure in the market. Another aspect that could contribute, was mentioned a lot this morning, is the CSRD request to include sustainability information within the management report. This could obviously foster issuers to give more importance to the coherence of the information that they put together. So this is a big picture that we have in the next future. And regarding our role, about your question, how we encourage a more cohesive system of reporting. So I have to mention that CONSOB was designated as a security regulator in 2018. And for the beginning, we adopted a supervisor approach that consider all the information published by the company. In particular, regarding sustainability information, we always have considered this information that could be in line also with the financial information. This for us is not difficult because we have a possibility, because in the CONSOB organization there is one unit that is responsible for both enforcement in financial statement and more recently for non-financial information. So for us it's easier to take into account all this information. This approach is also a result of some concern that had been raised from some stakeholders, because they pointed out that targets or risks that was described in the non-financial information were not always consistent with the information in financial statement. In particular, accounting of provision, the definition of useful life of asset, or the assumption underlying impairment test. In our recent internal thematic review of 2023 financial statement published in by the largest Italian issuers, we found that out of 32 companies, only 6 identified and quantified material impacts on their financial statement. Of the remaining 26, only 12 provided information and reason for not included material impact. So there is something that we have to improve in this kind of disclosure. Also, O.I.B.R recently, one research confirmed that stakeholders are concerned that information about the effect of climate-related risk in financial statement is sometimes insufficient or appear to be inconsistent with the information provided outside the financial statement. So the supervisory approach that we adopted has obviously an impact on the behavior of the issuers. So they're pushing to consider all the information in a more consistent way. In our strategic plan, the CONSOB reiterated the need to strengthen the supervision of non-financial information, and they established that we have to take into account the interconnection between financial and non-financial information. So this is a clear statement from our Commission. Lastly, the coherence and high quality of the sustainability information is crucial in order to address the risks of greenwashing. Considering the transversality of the issues, CONSOB aims to introduce new policies and an integrated supervisor model by considering and collecting all the information that we acquire during all our activities, and we would like to use this information to improve also the scrutiny, the supervision of ESG factor. So this is our task. It's very challenging, but we will do our best.
That's great. Thank you very much, and a really clear sense of what CONSOB is doing in order to address the completeness and consistency of information. And then we move on to the question of reliability and the role of the IAASB. And over to you, Christelle, just to give us a sense of this whole concept of the reliability and consistency of information being critical for the capital markets and business and investors, and we've heard that already reflected in this morning's session in several ways. And when we look at the future of corporate reporting and anticipate how the information ultimately will fit together in a more cohesive package, how is the IAASB as the global standard setter preparing for this? And do you have any particular perspective perhaps on the role integrated reporting might play in this regard? Thanks, Christelle.
Thank you, Jonathan. The IAASB anticipates that the future of corporate reporting will see financial reporting and sustainability reporting to be of equal importance to investors and other users' decision making. And for many, they already are equally important. So it means that both financial and sustainability information need to be equivalent in terms of reliability and consistency. We know that sustainability reporting is currently evolving. We know that entity system and processes need time to mature. So that's why assurance is a critical element in driving high quality reporting, and it's an essential part of the reporting ecosystem going forward. So to respond to the increasing demand for sustainability assurance, the IAASB has recently approved in last September the first international standard on sustainability assurance, ISA 5000. It will be published the next month after following PIOB certification, and it will be officially launched in January 2025. As you may have noted, I think, the IAASB has fast-tracked the development of ISA 5000. As I remember, the exposure draft was released last year for public comment of 120 days, and the IAASB received 143 comment letters. The objective of this fast track, at least in terms of standard setting, is to avoid fragmentation on financial market and to provide a global baseline for sustainability assurance. ISA 5000 is available to be applied by all assurance practitioners across different industries and various jurisdictions. The standard is written to accommodate any suitable sustainability reporting framework. It's very important to understand that ISA 5000 is profession agnostic and framework neutral. It aims to provide the basis for consistent, comparable, and high-quality assurance. And as a global standard setter, the IAASB has paid particular attention to 3 key points. The first one is that ISA 5000 is closely aligned in its approach with the international auditing standards, the ISA, and draws on the core concept and thinking in the IAASB existing suite of standards. So it means that the sustainability assurance will complement financial statement audit seamless. Secondly, the IAASB works closely with the International Ethics Standards Board, O.I.B.R, to avoid inconsistent definition, inconsistent concept, and to ensure interoperability on sustainability matters. And third and finally, the IAASB is fully aware of the need for connectivity between financial statement and sustainability statements. ISA 5000 not only supports communication between the sustainable assurance practitioner and the financial statements auditor, but it also does not impede the same practitioner or firm conducting both engagements.
Thank you very much, Christelle. And I think it's striking how we're thinking about the language that is being used across this conference so far, how much of the same ideas and language is being reinforced by each session, this concept of the global baseline of avoiding fragmentation and of cooperation as well between agencies and institutions. So thank you very much for that really important update. Now we've heard from each of our four panelists. Before we carry on with our conversation here, I just wondered if there were any immediate questions from the floor, from our audience. No, nothing at the moment. Well, we'll carry on our conversation and come back to the audience in a second. So, Guglielmina, I think coming back to you, if we could, you mentioned the ESRSs in your first reply. How will the ESRSs contribute to integration in reporting? And I wondered if you might provide both an Italian and a kind of broader European context to that question, please.
Yes, thank you. It's very difficult to answer your question about the contribution of ESRS because there are a very long list that we can discuss. So I will mention some of the most important, the main aspect. So ESRS are a cornerstone of the CSRD. So this is an important aspect because they cover crucial topics of ESG. So it's a very important standard. They will play an important role in fostering the comparability and the reliability of this information. So I have a very long list, and only I would like to mention that ESRS are based on existing standard and framework for reporting of sustainability information and take into account also other EU regulations. So this is an important aspect. And in developing ESRS, the European Commission asked EFRAG to harmonize their content as much as possible with to the other global reporting standard. So includes obviously those issues by ISSB. This is very important because this alignment could promote interoperability between these standards and could reduce burden reporting from multinational companies. We mentioned also this morning a lot of aspects. The SRS, the standardization reporting requirement is very important in order to assure comparability across different companies, not only in Italian, but also in the Europe. The ESRS introduced the concept of double materiality. This means that the companies must report on how, not only how the sustainability matters impact on the financial perspective and the financial performance, but how the activity of the company have an impact on the environmental and society. We mentioned this morning very often that the management report will include sustainability disclosure, so there is in one place the most important information regarding the activity of the company. Also, we discuss a lot is the connectivity. Connectivity is very important. The SRS asks that company have to provide information to the investor how these information are connected, and if there is something that is not in line, they have to consider. So connectivity, we discussed also this morning. So we have a lot of aspects of this standard that represent a pivotal step towards a more sustainability reporting in this field. Regarding the question, our concept, our Italian point of view, in accordance with CSRD, obviously listed companies will prepare the sustainability report in line with IFRS. The supervisor CONSOB competence on this matter has been confirmed by the CSRD transposition. So we are the security regulator in charge of the scrutiny of the sustainability reporting. The supervisor approach adopted by CONSOB is in line with the guideline issued by ESMA that will be adopted by all national competent authority in Europe. The aims of the guideline is to ensure that all the competent national authority have a common approach in scrutiny, non-financial the sustainability information, and also to have the common level of enforcement between non-financial information and financial information. And enforcement also for sustainability reporting will be discussed at ESMA level in a specific ESMA subgroup in line with what we do for financial information. Additionally, each year ESMA publishes the European Common Enforcement Priority, and in the last publication is the 2023. In the document, also ESMA reiterated the need for greater consistency between the information reporting, financial statement, and non-financial information, and stressed the importance of adequate disclosure if there are deviations between the assumptions used in non-financial statement and those underlined in financial statement. At last, in July, ESMA issued a public statement on the first application of IFRS to provide support to issuers in the implementation of the new regulation. So, regarding CONSOB, I would like to take this opportunity to encourage issuers, audit committee and audit firm to continue their dialogue with us that we started when we were the first application of the non-financial reporting directive. So we can discuss with companies and the audit committee, and we could support companies if there are something that is important in the first application of a new rule. Thank you very much.
Thank you, Guillermina, and thank you for that CONSOB view and the broader European perspective. And in a moment, I'm going to come back to Roberta to give a sense of how the IFRS Foundation has been responding to some of those issues, particularly around interoperability as we create the global baseline for disclosure standards for the capital markets. But before I do that, if I could come back to you, Christelle, and ask you, you gave us a really great kind of overview of what is happening at the IAASB with this 5,000. Could you just give us a sense of how you think the new assurance standards are going to contribute to a more reliable package of information for the capital markets?
According to me, a reliable package of sustainability information is achieved by having a global sustainability reporting ecosystem. And it relies on three key elements. First one, reporting standards that provide suitable criteria for measuring, evaluating, disclosing sustainability information that is reliable, comparable, and decision useful. And this is provided by various frameworks such as ISRS, IFRS, or GRI standards. The second one is assurance standards that provide for independence assurance, but the information reported is credible and trustworthy. And this is provided by the IAASB New Sustainability Assurance Standard, ISA 5000. And third, ethics and independence standards for the preparer and the assurance practitioner to underpin trustworthy information that is factual and not misleading. If we focus on the assurance part, ISA 5000 provides for assurance practitioners requirements that cover assurance any sustainability information reported, including greenhouse gas statements. ISA 3410 will be withdrawn when ISA 5000 becomes effective. Secondly, this requirement addresses the entire assurance engagement from acceptance to reporting. And so they provide a comprehensive set of requirements and related application material. And third, requirements are standalone and do not require reference to other standards, except for the fundamental premise set out in ISAK-M1 and the ISBA Code of Ethics, of course. In this broad context, I would like to highlight 3 key contributions of these standards to achieving a reliable package of information. First, ISA 5000 provides for both limited and reasonable assurance to support the transition in mandatory requirements from limited to reasonable assurance proposed in many jurisdictions. In particular, we've been very careful to clearly distinguish the work effort between limited assurance and reasonable assurance, and we included contrasting the practitioner's response to revise the risk assessment for reasonable assurance with a deep dive for limited assurance. Secondly, a great deal of clarification work has been carried out on the notion of materiality. In ISA 5000, we defined 2 concepts of materiality, the entity's materiality process and the practitioner's approach to materiality. With respect to the entity's materiality process, requirements and an appendix were included on the practitioner procedures, and the conditional requirement was also included for the double materiality, as both financial and impact materiality are required to be applied under some reporting frameworks like in Europe. And with respect to the practitioner's approach to materiality, the IFRS clarified that every individual disclosure does not require its own materiality and requires grouping of disclosures at levels which are relevant to the engagement, and it's an important point. Third and lastly, we have paid a particular attention to the issue of value chain. We have introduced requirements and terms for group engagements, including group and value chain components, and we acknowledge the challenges for the practitioners in obtaining sufficient appropriate evidence from the value chain. So, last but not least, we are currently developing implementation guidance and related materials. So we are continuing to work very hard on these new standards in order to support practitioners in applying these standards. And we are also looking forward to receiving market feedback on the first-time implementation. Thank you.
Great, thank you very much, Christelle. And Roberta, I think we've heard now from different parts of the ecosystem and different parts of the world as well. I wondered from your perspective, from the IFRS Foundation's perspective, what are the patterns that you're seeing in pulling together some of these developments as we move towards greater integration and reporting?
Yeah, I'm probably tracking development of what's happening around the world is one of my favorite topics. So we see a lot of update. There is not one single week without a development in a jurisdiction. And I think this morning, a few people already mentioned example like Guler for Turkey, Didi mentioned Nigeria, Vanya presented Brazil, somebody from the audience comment about Australia. So when we published the jurisdictional guide supporting jurisdiction in the journey to introduce the ISSB standard in the regulatory framework, I think we counted about 20 jurisdictions on the journey in different stages. We are probably now closer to 30, so a very big number. And what we have observed is that depending on the market readiness, the roadmap might vary. There might be jurisdictions starting first with requirement for listed entities and then introducing later maybe requirement for small, medium entities or other entities. And the similar pattern, I think, is also observed in terms of introduction of the assurance requirement, of course, waiting for the IAASB completing the work with the publication of the ISA 5000. Similarly, maybe starting with limited assurance, moving to reasonable assurance, or starting with assurance of some metrics and then extend later. So a diverse trend, but a lot of action coming from when I look to the list of the jurisdictions that are on the journey to introduce the standard in their regulatory framework, I'm always fascinated about the diverse compositions. So from the biggest contributor to the global GDP to the more developing economies.
Brilliant, and it is remarkable how, when you think about it through the lens of GDP, how much of an impact the work is already having. Just a final kind of, on our last kind of minute and a half, Vanya, we talk a lot about regulators, and I think people have got a view that it's kind of binary, either something is mandatory or it is not, but we know that it's a kind of interplay, a kind of ecosystem between regulators, between standard setters, and between the market. And I just wondered, given your role both in Brazil but also globally, if you could just give a little bit of perspective on the tools that are in the toolkit of regulators as they interact between the different players in the market.
Thank you for the question. We do not have a minute and a half, but I'll try to be very quick in that. I will start acknowledging the importance that it was for I.F.R.S. As the responsible for establishing the ethical code to work in connection with IFRS. And this cooperation was brilliant and very important because our staff came together in order to discuss even definitions. Because as reporting sustainability is new for everyone in a regulated way, we came to the conclusion that maybe using a different term would raise questions if they are meaning the same thing or not. So it was very important for us. And we understand that if we come together, the standard setter for assurance, the reporting, and the ethical side, we will be in the best position to serve the public interest in that. And it will make it easier for regulators to acknowledge this sense, because just suppose that one of the providers of sustainability frameworks ask a regulator in their country in order to make it mandatory. How will the regulator understand that the proper due process was followed by that institution in order to prepare the framework? That's the benefit that we have in a global ecosystem of reporting, because we can provide this security for the regulators so they can endorse the standard setters that are provided. In Brazil, we have announced that public sector, the private sector will be using IFRS S1 and S2 coming 2026 to be reported in 27. But there is a period of voluntary adoption in 2024 and 25 where we'll be asking just limited assurance. The message that our regulator wanted to provide is very clear. We want sustainability information, but we want it reliable. We want it supported both by ethics and by assurance that will come into force in 2026. And we are sponsoring the Brazilian companies in order to incorporate this voluntary period, in order to test their models, to start testing the internal controls, because for us to have reasonable assurance coming 2026 is a very clear message. We want sustainability information with the same level of quality that we have for the financial ones. We do not want information on sustainability to be viewed as something superfluous or additional or an add-on, but a strong position that will make companies to come to integrated thinking and use this information, the report not to be the end of the process, but a very important tool for the management to make decisions.
And a powerful message. Thank you very much.
Okay. And now, more and more difficult. Deep dive. Intangibles, integrated reporting, and connectivity. We will have, as moderator, Nick Anderson, member of ESB, And panelists Jan Bishop, Head of Accounting Consolidation External Reporting Roche and Chair Global Preparers Forum IFRS Foundation, please. Chiara Del Prete as Chairwoman of IFRS Sustainability Reporting Tech. Jean-Philippe Desmartins, Head of Responsible Investment at Edmond Rothschild and co-chair of CESGFS and chair of Wiki Europe, and Marco Pasquotti, Nord-Est President of AMDAF, Italian CFOs Association, and partner of Euskali Capital and member of our supervisory board. So, Nick.
Thank you, Alexandro, and good afternoon, everyone. So, as Andreas mentioned this morning, every 5 years, the IASB consults on what its work plan should be for the following 5 years. And as a result of that, the last time we did that, we decided to add 3 new projects to our research pipeline. One of those, which is the project on intangibles, which we're going to talk about this afternoon. So I'm delighted to have such a esteemed panel with me to help me through this. It's a very broad class, I'm going to call resources, not assets, I'll be careful, a very broad class of resources. And we're going to create some magic this afternoon by the panelists are going to help me create an intangible resource before your eyes to provide some insight on how we should move forward with the panel. So that's the challenge. So Jean-Philippe, let me start with you. As an investor, what would your priorities be for the IASB's project on intangibles?
So thank you. Hello, everyone. So before answering your question, I would like to thank you, the organization, to have the courage to address intangibles. It's not because it's complex or difficult that we don't have to address it. That was the same thing 25 years ago when we started addressing sustainable finance and sustainability, and we do it. So that's the same message. So happy to see that IASB is brave to address the subject, and I can only, in the name of the investor community, congratulate that we have this congress, which of course will address accounting issues, but also financial reporting and extra financial reporting. So that's my global message, having in mind that, of course, we know that if there are some changes regarding accounting, it will take time. We have to be patient. We were patient for the last 25 years. We have to be patient for the next 25 years. So, but we have to do it, and I'm always very optimistic that we will do it. In the more short term, of course, good news. We have management report and we have integrated report. I'm not going to detail everything which has already been said today, but thanks to integrated reporting, we have human capital, intellectual capital, connectivity, etc., and that's a great thing. And yes, what we are waiting for is to address broadly intangibles, be courageous again, relational capital, organizational capital, human capital, don't divide. We have to assume the complexity, the systemic approach. It's like sustainability. We can't afford doing silos. Think about sustainability. You want to address environmental issues, in France, you get the yellow jackets. So I just give you the comparison with sustainability. That's something with the tangibles we have to address broadly. So I see some distinctions as in investors. I don't understand them when some people tell me intangible with sustainability links or financial links. No, we have one brain. I'm also a portfolio manager. So we have to address everything broadly. And last but not least, of course, we have to start with something. And I know that there is also another project dealing with human capital. And I think that human capital is a good step because there is something on the table at the SEC regarding human capital. Japanese are quite in advance. There is CSRD. And so we have also some ISSB project with human capital. So why not starting with that? Thank you.
Thank you. So you're right, the ISSB has started a project on human capital, which we are keeping closely in touch with. So Marco, from a practical point of view, you advise clients on M&A transactions. How do they go about assessing intangibles when they're thinking about potential acquisitions?
Thank you. Yeah, from my point of
From my point of view, intangible assets such as intellectual property, brand value, human intellectual capital, or customer relationship have become critical factors in M&A evaluations, particularly in knowledge-intensive and technology-driven sectors. In some cases, the value of intangible assets can overcome that of tangible ones. So making the proper evaluation essential for to determine the acquisition price. So what are the methods to evaluate these intangibles in practice? Sometimes the first method, is the discounting cash flow method. So using DCF methods to estimate the future financial returns directly come from these generated by these intangible assets. And this approach helps you to determine the direct contribution of these assets to the company's profitability. Another approach can be cost approach. So the calculation of the cost to replicate an intangible, such as developing a technology in-house or building a skilled workforce. Okay. But besides that, in the recent years, environment, social and governance factors have played an increasingly important role in the evaluation of intangibles. So there is a great emphasis on the company's ability to drive the sustainable innovation in some way. So as advisor in M&A transaction, we try to understand how the company target is well positioned on to capitalize ESG opportunities, for example, but at the same time to measure and mitigate the ESG risks around ESG factors. Yes, because ESG opportunities can lead to future positive financials, cash flows, okay? But also ESG risks, if not properly managed, can lead to negative future cash flows. So to manage this in a proper way, integrated reporting and maybe also financial materiality assessment can be essential tools to point out the ESG opportunities and risk, and so sometimes to influence also the acquisition price.
Sure. So you have to bring all these factors together, actually, because ultimately you have to pay a price for a company rather than the individual bits. So you try and combine this information in terms of using various techniques, thinking about risk to come up with that valuation, or it helps you inform that. Okay, thank you. Ian, I'm coming to you with sort of two hats. So thinking, obviously, from a company perspective, what would you see as we could do to best help investors through this project get better information about intangibles, but at a reasonable cost? You know, clearly we're always trying to weigh up costs and benefits in our work. What would be a sensible approach?
I think this is a mission-critical project, and I think the existing accounting simply doesn't work. I think it's particularly in the pharmaceutical sector you see it, because probably, I don't know, 3/4 of our market cap is in intangibles. When we look at M&A, 100% of what we're paying for is intangibles. And the numbers that are on the balance sheet are irrelevant in that respect, because, and we're talking about pretty tangible intangibles here. So this is product rights for pharmaceutical products, which are patent protected, and you know, these are marketable. You can buy and sell them. They are literally worth money, and actually when you buy Roche shares, that's actually what you're really buying. You're not buying the accounting expertise. And yet, what is on the balance sheet is a complete mishmash. It takes, we estimate it, the headline number, it takes $1 billion to develop a drug. If you've done that internally, that's all been expensed through R&D. If you've acquired that at some point through an M&A deal, you're sitting on some IFRS 3 fair value that might be sort of 5 or 10 years old. If you've in-licensed it, you might have a stream of milestones. So it's completely arbitrary what's in there. So what everyone does, the analysts, investors, but also internal management, whatever's on the balance sheet, red line, kick it out. They're not interested in it. And it's the same thing for an M&A deal. If we're looking at a target, whatever's on the balance sheet, we ain't paying you a penny for that. But we do look, we basically revalue it all. So what is done now is literally useless. Now, everybody's got to work around that, but where it now becomes critical is because we need a firm foundation when we're looking at integrated reporting, impact reporting. If we haven't got our act together as an accounting profession, financial accounting, on the intangibles, you haven't got a foundation to then go to the next step with the integrated reporting, impact reporting. So I think it's really mission critical that we do this, and I think what I would encourage the board to do, I think you've got to be really focused on this. And you've got to be actually a little bit brutal. Don't be too nice. Goodwill, scope it out. A few of the usual suspects, cryptocurrencies, software as a service, cloud reporting, yes, deal with it, but deal with it in a little sort of isolated project. Don't get sidetracked by that. Don't get financial accountants doing fair values and valuations. Our job is to provide the information, let people do their own valuations. I think what people are interested in actually is the cost. So we get cost, they can do their own valuations of our intangibles. What they're interested in is how much money we spend doing it, what our R&D efficiency is. So they're more interested in the cost rather than the fair value. And maybe a little bit controversial, this project, try to avoid that it becomes a kind of Trojan horse that every sustainability topic somehow gets thrown into it as well because we want to get it audited and whatever. I think we need to sort out the financial accounting and we need to be a little bit consequent with that. I'm not saying it doesn't need to be addressed, but I am saying that I would encourage the IASB not to get sucked into that. Ultimately, I think you need to decide what is an intangible asset, i.e. what goes on the balance sheet, and what's an intangible where you have disclosure. And just if you're putting something in a balance sheet, you've got to ask yourself this: how do I calculate the cost? Where does that number come from? Do I amortize it? What's the useful life? And if I'm going to test it for impairment, how the heck do I calculate the fair value less cost to sell or the value in use? And if I can't do any of those things, you're dead in the water for the financial accounting. So I think and this needs to be done. I think if you focus this down, I think we can get some action on some of this because it's quite frankly long overdue. And the whole, as I said, the whole topic of integrated reporting means it's really rather urgent that we do this.
Thank you. And we're at an early stage in the project. We're still really at scoping, so we're trying to put our arms around what are the key issues to look at. Chiara, rather cheekily, I'm going to ask you to wear your old hat because you were very much involved in IFRS research project on intangibles some time ago. And one of the recommendations that came out of that, or suggestions to look at further, was something called future-orientated expenses, and whether this was a route in terms of looking at certain intangibles or some intangibles. Can you explain a little more what's meant by that, and whether a number like that could truly be comparable from one company to another?
Yes, so in the research, we explored the different possible solutions to work as a combination altogether, because as you said, it's a very broad category, and so one solution wouldn't fit everything. So we focused on what could help for the intangibles that cannot be separated, so that they explain their value creation in combination with other intangibles or with the rest of the assets of the company. And the idea is that in the current expenses, there are expenses that have the potential to increase the profitability or the revenues in the future. And this came in dialogue with users that would like to understand better the margins of the company this year, but also how this could potentially be a prediction of the increment in the margins in the future. Now, of course, the tricky question here is how to differentiate in a comparable way which component of the expenses of the reporting period relates to the future and has potential to bring benefits to the future. And there were basically two possible approaches. The first is to leave to the company the judgment to determine themselves the future-oriented expenses. But of course, the users weren't enthusiastic about this idea because, of course, they wanted to have fun themselves in trying to make their own mind. And the alternative would be to produce a granular breakdown of the different categories of expenses. Imagine a table where you have in the columns the type of possible future-orientated expenses, such as marketing, such as research and development or training. And even further, the component of the marketing that is maintenance and the component that is creating new market shares, because that's what we would like. So imagine these columns, and then in the lines, of course, you have the other type of expenses, and everything reconciled then with the income statements. That would give to the analysts material to do their own calculations. But of course, there is an element of burden in determining the right level of granularity for this information. Then the question is, but would this be a complete solution? Probably an idea of a combination of the two could be even better, in the sense of asking the company to disclose their own assessment, corroborated then by these breakdowns.
Thank you. It's interesting, the question about differentiating between let's call it maintenance and growth investments also come up in our discussions around the cash flow project, which is another of our new projects. And I think it's a kind of interesting discussion whether that's financial analysis or financial reporting, really. But we can leave that for another day. Jean-Philippe, I want to come back to you because we touched upon making comparisons, and clearly at the heart of what all investors do is they make choices. They compare investments and they decide where to allocate capital. And one thing we hear in this sphere is that it can be difficult comparing companies that grow by acquisition with companies that have an organic growth strategy. And that leads you to making decisions about whether one should recognize more or less intangibles. I'm just interested where you fall in that debate.
Yeah, yes. Of course, looking at how we could have more accounting dealing with organic growth models, of course, will be a plus, especially because as an investors, organic growth models are less risky when you are an investor, simply like that. So that's the first point. You know the stories that when there are M&As, there are goodwill, etc., etc. So, and just take the example of Hermes, market cap of Hermes, luxury company, 250 billion euro, significant amount. In the balance sheet, the brand is zero. It's a luxury company. Perhaps there is something to do. At the same time, I mean, when we think about intangibles, some intangible will never be addressed with accounting. That's not a problem because we know that there are a lot of positive non-accounting intangible resources. The example being corporate culture. When you are long-term investors, you know some stories, you are invested or not invested, and you remember the positive or negative impact of some corporate culture. Wirecard in Germany. If you had addressed before the corporate culture of the company, you would have avoided it. But it's not accountable. So we have to address both. Of course, we like to compare, but one complexity of intangibles is that some intangibles and great intangibles are unique. A brand is unique. So of course you could compare Hermes with Chanel, with Dior, with Richemont, etc., etc. But think about intangibles. Some are unique. Some can be compared. Client satisfaction in the same sector, or R&D in Labo Pharma. So we need metrics. And we have already KPIs, Wiki, in the past, developed KIPs, metrics dealing with intangibles, so we have something. And last but not least, Stefano announced the launch of the Strategic Intangible Initiative. It's a completely open and inclusive. It's really to work together to progress. I think that we all have to do some efforts to better address, and this is the objective number one of this initiative, to start. Thank you.
So sticking on the subject of acquisitions, Ian, Roche, and these were your words, makes numerous acquisitions.
Numerous.
Yeah, you told me to use the word numerous acquisitions each year. I mean, how often do you get questions from investors specifically about the intangibles that you recognize on those acquisitions? Is this just...
In terms of the numbers that we disclose?
Yeah.
Frankly, Scarlett, they don't give a damn. They don't ask about the numbers. They're interested in the assets, but they already know about the assets because actually probably a lot of our investors are even tracking the target. Mm-hmm. And when we do the press release with the announcement, they will have do their assessment because typically the deals we do are sort of credit, cash, debit, goodwill, and intangibles kind of type of deals. So they'll have already done their own assessment. What we stick in the financial reporting, they don't know and they don't care. Because you could have a deal, say it's got, I don't know, one marketed product and a couple of products in the pipeline, then you've got one number for intangible assets available for use and another number for not available for use, and then the answer is 42. Mm-hmm. But what should they do with that? They're more interested to know there's product X, there's product Y, there's product Z. We think peak sales are going to be this. It'll be approved on that date. The key competitors are product A, B, and C from these guys, and then they can build they can do the valuation themselves. They don't care what we do. And actually, the number we publish is anyway irrelevant because it's a market participant number and it's not a Roche-specific number. So we're not using our own cost of capital. So really, they don't use that at all. They're interested in the information, but not the number.
So they'll take other information that you supply, let's say on the day of the deal announcement, and through that other information, they will opine quite quickly their view whether whether you paid the right price or not, I assume.
I think the good news about this topic now is everyone knows how rubbish it is, that we've all got workarounds for it. So it's not like there's a sort of failing in market failure that investors don't do it. They just don't use the numbers in the financial statements.
And one could argue when we see the gap between market price and book value, you can say investors are very good at working around this and that perhaps we shouldn't be.
Well, I hope so, because our market cap's a lot higher than our book value.
Right. Good. Let's turn to connectivity. So combining your old and new role, really. And really, I think just the conversation we had has illuminated some of the challenges in this space in terms of how to analyze intangibles, including with companies with different growth strategies. So what role can connectivity play here? Are there some practical examples that you can share with us?
In the sustainability statements, we report on financial risks and opportunities that are related to sustainability matters. And looking back at the issues that we have with the intangibles and what the analysts want, first of all, they use all the information from all the different reports. Therefore, it's important really to be able to communicate an holistic story, so a story that stays together from a preparer's point of view. But from a standard setting point of view, of course, the role of connectivity is to help navigate the different elements of information, knowing that each of them is responding to a specific disclosure objective and to a specific conceptual framework of what to say, formalized or not formalized. And therefore, it's important to know what we can find about intangibles in the notes to financial statements, what we can find on the balance sheet, what we can find on the management commentary and in particular on the sustainability statement. And then, of course, we were talking about intangibles that cannot be appreciated in isolation from the rest. And here we move from tangible intangibles that he mentioned to another interesting concept, which is intangibles. And that's where risks and opportunities play a role, because risks and opportunities are a bit behind the scene of what can be recognized and appreciated and measurable. So, examples, think about the disclosure on human capital, or in our language, on workforce. That is something that is able to complement the information that is found in the notes to the financial statements. But more generally, the long-term attitude of a company, the governance of a company. And there is an element which is overarching to both the financial performance and the sustainability assessment, and it's the strategy and business model. So I would say you can reach even the conclusion that the attitude towards sustainable matters can be in itself an intangible. One of the fascinating elements of having traveled from one side to the other of the river, so from financial to sustainability, is that the first conversations with the sustainability people, without necessarily a reporting or a financial background, the first thing that they said, yes, but what about intangible liabilities? And it's true in a way, if you want. So we speak here about resources, of course, but then in the sustainability statement you also find the risks. But it was mentioned also before that the sustainability matters are a source of value, but also of erosion of value, because they expose to risk.
And you're absolutely right, because investors are seeking to incorporate all of those things where they're material into their thinking to come up with an assessment, so they can, I guess, to weigh up the risk-return equation from their perspective of committing capital. So those things are all important. And certainly I think there are, in my experience, the last role I had was managing a sustainability fund, was that there was informational value in terms of how you manage those risks and opportunities. And indeed, we started to find a correlation between whether those were well managed or not, and whether companies made good acquisitions. It's just a way of thinking, really. So it was powerful in that respect. So sticking with human capital, Marco, I want to come back to you and how you would think about a people-orientated business. And we know, compared to certainly when I started my career, there are many more business models and businesses today that are dependent on intellectual capital than certainly when I started. So how would you go about assessing the strength of the competitive position for a people business?
The critical factors to assess the competitive position of these type of companies include human capital, relationship capital, intellectual capital. So human capital means the quality and the skills of the employees, thanks also to the capacity of the company to attract and retain talents, and also for the training activities, the diversity and inclusion efforts of the company. The relationship capital means the strength of a relationship with the customer, partners, suppliers. So a strong network of a relationship is crucial for the a competitive position of the company. And also intellectual capital, because if there is an ability to adapt, innovate over the time, it's very important for the competitive position of the company. How to provide context to this information? integrated reporting framework with the concept of multiple capitals can be one of the best way to provide this context. Also, integrated reporting enable you to highlight, to illustrate some intangibles not recorded in financial statements and sometimes excluded in the sustainability reporting. Among our former capitals, for example, intellectual capital or relationship capital, is not so easy to find this type of information in a traditional sustainability reporting, not integrated reporting, okay? So I am a strong advocate of integrated reporting, having prepared one of the first integrated reporting of an SME in Italy 10 years ago, when I was a CFO in that company, okay? And since that, I have, as consultant, I have prepared different integrated reports for different companies, and this is the point. Sometimes, for some companies, intellectual capital or relationship capital can be very important in the value creation of the company, in the value proposition of the company, so also in the competitive position of the company. So I could make some examples, but okay, these can be, so integrated reporting can be a way to highlight this type of information and to have in some way an illustration on a measurement of the competitive position of the company.
So you'd use the integrated reporting framework as a construct to organize that information in terms of the capitals. But how important is it to sort of to provide metrics and evidence alongside some narrative reporting in that respect? I'm not saying it has to be financial, but non-financial as well. Is it a combination of narrative reporting and evidence to sustain and substantiate that reporting?
Yeah, some information can be only quality information and not quantity information. This can be in some way a limit, okay, compared with the information that you can find in the financial statement, for example. But this is important in a narrative and the illustration of the company. It's not possible to measure all things if you explain the strategy, if you explain the position of the market. Okay, you can use quantity KPIs, but sometimes only qualitative type of informations.
Thank you. So we're going to try something slightly different before we go to Q&A. So what we found in this space in the early part of our research project is we found it's very easy for people to talk past each other in this area because the spectrum of resources that we're talking about is so broad. So Cara, you may have a particular intangible in your mind, but I've got a completely different one in my mind, and we're thinking we're having an argument, but we're just not thinking about the same thing. So we're going to run through a few intangibles and just get a sense of the panels of what's their preferred reporting solution for those specific intangibles. And I had software on my list, but unless anyone wants to change what we're doing today with software, which is probably more at the tangible end, we can all agree on we're kind of comfortable with the status quo.
No.
No. Go on, Ian. Tell us different.
Software, I think if it's commercial software where there's a revenue stream and you're going to sell it, I think yes. So you could look at people that develop sort of video games. Actually, we develop commercial software for some of our diagnostics instruments. But other than that, I think you should expense it. I don't see how you estimate the value in use. And by the way, if you start capitalizing it, you lose all control over your IT budget.
Okay. Ian's unhappy about all the treatments, I fear. So, all right, let's keep going then. And we'll work our way down from Jean-Philippe. So what about brands?
Yeah, I would like to promote again human capital because as
we'll come to human capital.
Okay.
Because again, let's start with brands, and you can differentiate between acquired and organically generated. But what would be the preferred accounting treatment for a brand? Do you want it recognized on the balance sheet? Would you not have it recognized on the balance sheet?
Yes, recognized, yes.
Irrespective of if it's acquired or generated organically, you'd have it recognized?
Yes.
Yep, okay, that's great. Marco?
Yeah, all of them can be recognized in a business combination, for example, but without a business combination, software or brand can be, but customer relationship, no. Human capital, no.
We're going to do one at a time. So brands is only if they're acquired.
Okay. No. Sometimes yes, sometimes no.
Okay. So the existing treatment. Okay, Ian.
I think you do need to align between IFRS 3 and IAS 38 on this. I don't think you can have two different answers. I think it depends. I actually looked it up. Rolls-Royce is a brand, like the motor cars. It's actually owned by BMW. So I'd say they obviously paid for that. So I'd say that, I could argue that. But BMW is a brand as well. But that represents the whole company. I'd rather say you disclose what the brands and trademarks are, and you might want to disclose this one we developed internally, that one we bought 5 years ago for $10 million or whatever. And I could argue the ones you acquire, you might want to sort of stick on the balance sheet and depreciate over 10 years or something, but kind of situation. I don't think you want internal brands is actually, I don't see how you can differentiate it from the whole company.
Chiara.
Well, I don't think in our report we were so aggressive to suggest to change dramatically the accounting, because in theory you could say that everything that meet the recognition criteria, so that you can control and reliably measure, could be eligible for the valuation. But then at the end, in terms of the brands, in terms of recognition criteria, probably you would have to go at cost. So I don't think we were suggesting to expand that much, other than to remove a few limits that there are today in IAS 38, the limitations that there are today.
And would that be the same for customer relationships? Because I'm going to work down this way.
Well, customer relationships, then you may differentiate further between those that are contractual and those that are not contractual. So for contractual, you could have a reliable way to derive a value.
Okay, thank you. Ian?
Yeah, the same. I think if you can buy and sell them, I could make a case for it. But a sort of if your customers think you're really good, I'm not quite sure how you even test that for impairment. So I think if there's a market, yes.
Yep. Marco?
Yeah, customer relationship is difficult because it's related different type of relationships, long-standing relation with the customer or strategic relation with the suppliers and so on. So it's not so easy.
Okay. And Jean-Philippe, and then
So, of course, the accounting points has been discussed, but having at least information such as diversification of the client portfolio, tenure, I mean, of the clients, etc., is really a plus that we can have in the management report, integrated report. So in addition to that, we can have metrics.
Okay. So the last one was going to be human capital, but I'm going to just try, I assume everyone would like that to be dealt with through integrated reporting or management commentary, but tell me if I'm wrong, I assume no one is seeking a value for human capital on the balance sheet, or am I wrong?
Partially think about trainings, trainings effort, and especially when the people are receive qualification, it could be one way, but as very partially, as you say.
Well, I guess the problem is the concept of control, no? Yeah. In a way.
Yes, and slavery is over.
Yes.
We must remind that, and it's a good news.
Perhaps it's the least asset.
The question with all of these is, with anything you stick on the balance sheet, you've got to ask yourself, how does it get off the balance sheet? So if you put this kind of thing on the balance sheet, how are you going to depreciate or amortize it? How are you going to test it for impairment? And if you haven't got good answers to that, it's maybe something you should, I'm not saying you shouldn't disclose it or it's relevant, but I'm just questioning whether you even put it on the balance sheet.
Okay, thank you. We now have some time for questions. If we have any questions, 2 minutes. It says 8 down here, but I'll go with you. If you tell me 2, you're the boss. A question. I've got.
Yeah, Ian, one for you.
quite right about, I guess, not the job of the accountant to value intangibles. The market does that for you. Does the make or buy question whether you buy an intangible from buying another company or develop it organically affect the way that management think about it in terms of its key ratios?
Well, I think that's.
In other words, do they try and are they influenced by their key ratios as to whether to buy something in or to make it themselves?
Go on, Ian.
You've got to be very careful about that sort of thing, because if you let the accounting run out of control, you can find it incentivizes the wrong decisions. So when we have, we develop a portfolio of drugs and we may have sort of 2 or 3 candidates for the same disease area. And when we decide which one to develop and take forward, it's a very expensive business. So the one we choose, we want to be the one with the best science and the best commercial prospects. And whether we in-licensed it or developed ourselves, that's kind of a sunk cost. So we take that out of the consideration. And this is where the existing standards kill us, because you could have 2 candidates, and one of them, if you in-licensed for $100 million, which is quite easily could have happened, and the other one you developed internally, if you impair one of them, or if you choose one of them, you've got 100 million impairment, and if you choose the other, you've got nothing. So which one should you do? That's basically why we take this impairment out of our non-GAAP measures, and we take it out of the internal management KPIs as well. Now, it's not to say we don't track costs, but we just don't use the current financial accounting to do that.
Thanks, Ian. So it's been signaled to me that our time is at an end. So please join me in thanking our panel this afternoon. Very much appreciated.
Hello, thanks. So we have the last panel of this session, and then we will have a working break. The panel discussion will be on the role of integrated thinking. We have talked much more before, but now we can increase our knowledge. The moderator is here, Kruppelman, partner of Graham Thompson Impact House, chair of IRF Foundation Integrated Thinking and Strategy Group, while the panelists are Mary Adams, co-founder of Insight 7 Incorporated and Integrated Reporting US Community, Jeremy Osborne, global head of ESG, ASPA, and CIMA, Lee Roberts, chief executive Integrated Reporting Committee of South Africa. Thanks so much for being here, and you can begin your speech.
Thank you so much, Alessandro. And great to be here. Thank you for inviting us. And of course, this is the most important panel of the day, so thank you for sticking with us. And we will have time for questions at the end, so I know this, it's been a long day, maybe for some of you, but if you have a question, I'm counting on you to ask a really good one at the end. And thank you, panel members, for being here. We have some people from all over the world, and I'm going to start with just the current state of affairs on integrated thinking from all over the world. And Lee, I'm going to start with you. From a South African perspective, where, from my perspective, integrated reporting at least was founded and is so strongly present. What would you say is the state of play around integrated thinking in your region?
We've been doing integrated reporting since 2011, and honestly, the biggest tool is applying the integrated reporting framework. Many companies have said that has changed their mindset, and there's empirical evidence out there that all you need to do integrated thinking is just follow the framework. The framework it's designed to show the circle of integrated thinking, and that being, you take the inputs from your 6 capitals, they churn through your business activities, and you produce your outputs, your products and services, and then your outcomes on each of those 6 capitals. And in turn, those outcomes come back all the way in and affect the company, and the inputs that the company uses is going to need for its future strategy. So we see the framework as, honestly, as I could stop right there. It's all you need to do. It's designed to show the connectivity, which is the reality of the business, the connectivity between the content elements. And also, what I like to stress is the feedback loop. There are two big areas in the report and in business where it's in stakeholder relationships and external environment, and how those factors are responded to by a company. And that could either be in its strategy, risks and opportunities, or its material matters. That is a connectivity. So I'd also like to make the point that we had to start with the integrated report yet. We didn't have time to apply integrated thinking first and then do the report. So that again shows that the evidence of do the integrated report and your integrated thinking gets done. And just quickly, if I may, so if you look at an integrated report, and there's some ways to pick up if a company is applying integrated thinking or not, if they deeply understand it. So the first one I can say is the business model. Look to see if they have negative and positive outcomes on all 6 capitals in their business model, or if it's just value creation. It's got to cover value creation, preservation, erosion. Take a look at strategy. Does it include all 6 capitals, including sustainability? Risks and ops. Does the determination process include the 6 capitals? And finally, integrated thinking should be mentioned in each and every section of the integrated report, because that's how fundamental it is.
Thank you, Lee. Going to Mary first from the US perspective, which is quite different, I would say, than a South African perspective in terms of integrated thinking and reporting, maybe on many other topics as well, but we'll stick to integrated thinking for today. What would your view be, Mary? You've been studying this for a while now, and what is the state of integrated thinking from a US perspective?
Well, you're right. We are the exception to almost everything that's been talked about today in terms of the structural answers to the move towards integrated thinking and the changes that we all need to make in our economy and our society, our businesses. I can't answer for the politics of today. It's something that confuses all of us. But I would say the state of play is much more advanced than most people assume in the US. I think a useful way of thinking about it, I took a great class on stakeholder capitalism at Berkeley School of Law, and they talked about values, value, and innovation all being drivers of these changes. The values part has become extremely political in the US, so we've kind of stopped talking about it. The value, the risk side of things, we're very good at, and companies are spending more and more time on it. Again, they're not talking about it quite as much as they did even a year ago. But there's a lot of money being spent. We have a lot of people in our community. The integrated reporting community in the US is very quiet this year, but we did over 40 programs in the last 6 or 7 years. We have some wonderful videos on YouTube if you want to see some of the stories. We took very much a storytelling approach to describe how companies are thinking and reporting in many cases in an integrated way. We're not ticking it off against the framework, but the framework was an extremely important inspiration to the companies that began to do this. So, and then finally, I think the innovation side of things is something that has been mentioned a little bit today, but I think it's something we all need to lean in on, because that's one of the most exciting things about this. I like to say to people that sustainability is one of the sparks that I think will fuel our economies for another 50 years. If we're going to remake our homes, our buildings, our transportation, how we make products, what we eat, that's an incredible opportunity to both make money and change the world. And that's the wonderful intersection and the opportunity that we have here with the integrated model and integrated thinking to help people get there. So it's a mixed story from the US, but I think there's a lot going on, and I hope that we find more ways to build bridges with this community, because there's a lot of great things going on. And I came here because of the integrated, the multi-capital model many years ago, and it's still, I think, the essence and one of the most important assets that was acquired in all of these mergers. So.
Thank you, Mary. Jeremy, you were at the VRF prior to your current role, and at IRC, I think also, and one of the designers of the integrated thinking principles, so which was acquired by the ISSB, or by the IFRS Foundation, I should say. But now, in your new role at AICPA and CIMA, what do you say is going on from your perspective in the world of integrated thinking?
Great, thank you, Tjeerd. As you said, I was very fortunate to be involved with helping design the integrated thinking principles, working with Charles, who's in the front row. And if you think they're rubbish, come and see me in the break. But hopefully you think they're of use. I think integrated thinking as a concept is coming of age, but I think there's still plenty of work to do. It was very heartening this morning to hear Emmanuel and Andreas talk about the business benefits and the value of adopting an integrated thinking mindset, and to hear explicit references to the integrated thinking principles, which, as you said, are now part of the IP of the IFRS Foundation. But also, as we heard, there won't be standards around these. It is integrated thinking as an approach to management, and therefore obviously of importance in the context of what companies disclose, but difficult to wrap a standard around that. So I think my view, particularly from the UK, but with what I see across the patch at AICPA and CIMA, is that integrated thinking, as I said, is coming of age. We heard from Emmanuel, I think this morning, that he first started engaging with the concept around about 20 years ago. I first heard about it in the integrated reporting framework in a very early version of that, which was in 2012. And I think with the publication of the integrated thinking principles, that provided some structure. But it's still a little bit nebulous. So I think now we're at a point of maturity with what should organizations actually do to embed integrated thinking within their business and within their operations. And that's, I think, a sort of, it's growing pains in a way. I think it's a really good sign that we've got to that point. But I think there's work to be done around what does it actually mean in practice. So, for example, we've worked with WBCSD on a framework called Integrated Performance Management, which my colleague Peter, who's going to wave now, has been working on. And the Integrated Performance Management framework really takes the underlying principles of integrated thinking and then provides a structured approach to how to embed that into operational processes and working that all the way through to management information. So I think that's timely and a helpful contribution at this stage. With the work that you led as the chair of the special interest group on integrated thinking, there's a host of, I think, really inspiring case studies of organizations. And there's a lot of conceptual research that's part and parcel of that. But I think now we're at a moment where we really need organizations to embed integrated thinking into their operations. And I think the Integrated Performance Management Framework is a good place to start. I'm sure there'll be others that will evolve over time. And that's what I would hope we'll see develop in the years ahead.
Thanks for that, Jeremy. Also the reference to the case studies, because we heard a lot about developments of standards and convergence and consistency and all that stuff, but there's a few practitioners here in the room. I talked to some of them during the break as well, and they actually have to do this stuff, right? So it's great that we're working on convergence, but someone else has to write these reports and bring them out there. Maybe a question also to you, Lee. What else could be developed or is needed for these companies to actually be doing this, or to keep doing this, or to improve their work on either the reporting or the thinking side? They're so intertwined, so I don't want to separate from them. What else would we need it, and perhaps what else could ISSB or IFRS Foundation do to help these companies?
Well, at the risk of sounding boring, the framework is fit for purpose. Totally agree with Charles on that. The framework is fit for purpose, and it's honestly designed it was designed with a purpose to bring everything together. So if you follow that, and I think that you can, you can achieve integrated thinking. Integrated thinking is not a one and done. It is a continuous process. I don't think you ever get it done. It's finessed and honed over time. And then I think if you focus on the 6 capitals, it's a wonderful mindset change, of what you're using and relying on, and what your outcomes are over short, medium, and long term. So it's a wonderful mindset change, and so perhaps there should be greater focus on the 6 capitals over short, medium, and long term. Now, some companies sort of roll their eyes at 6 capitals, and they don't really understand it. Still after all these years. And so if you explain it as risks and as your resources and relationships, they get it. And then when we developed the framework, it was always meant to be a categorization process to get the mind into thinking completely.
So the framework fit for purpose, more focus maybe on the capitals or on the application of the capitals or application of the framework. Is that is what is needed to drive this even further?
Those two, and more internal to the company. Something that Emmanuel mentioned this morning reminded me that if you bring it into your performance incentives, your remuneration, and you make those holistic, it's also a very big driver of integrated thinking.
It always helps. Mary, from the US perspective, and you shared a little bit of the dilemmas that you face there, right? But what would be helpful for the US market?
Well, I'd like to address that quick. I mean, I think the US market, we're frankly, in our community, trying to find the way to come back, because S1 and S2 is not an easy entry point for conversation. So that's something we're working on. But I want to take a second to talk a little bit about this question of, what do we need, and where are the opportunities? I see what's been happening with the sustainability market, and it's kind of mirrored in what's happening with the IFRS. There's very important work going on to bring in and do the work of the sustainability function within organizations and to build up capabilities. And if you think about the last 40 years since we've been digitizing our businesses, what we've really spent most of our time is optimizing silos. People keep talking about the silos today. And there are tools for everything. We've got tools in all of these silos, and they're wonderful. It's made us who we are. But how many tools have been made to optimize the systems? And we talk about the connectivity, and we talk about how it all makes sense, but we need to use technology to optimize the systems. And people that know me, I wrote a book on intangibles in 2010, never updated it, just keep doing it. But I've always seen this organization as the home of the multi-capital model. And if you think about the silos of financials and sustainability, which need to be always there, there's a second element to sustainability, which is holistic and integrated and systems thinking. And that's really the gem here that was acquired and is important, and we heard a lot today that it continues to be important. It's not as high a priority, but if we only give people report cards and we don't give them find ways to empower and equip people to make integrated decisions and to manage in an integrated way day after day, then we're not going to get the change that we want, and we're not going to be able to, as my colleague says, every day I say move the needle at least 5 times, but that's what we're here for, is to move the needle. And so, and real fast, the way we've been using the multi-capital model is to talk about the formula. Bring customer capital into it. Every organization is trying to build value for customers, but in a way that builds value for their organization, their external stakeholders, and their environment. If you can equip people with that framework and the data that goes with it, then you can make decisions on your business as usual, and also the long-term planning and resourcing decisions of strategic projects. So I think more work on the multi-capital model is worth it, and I'm so glad we had this discussion about intangibles before this, because really, if you think about what's missing in this conversation between sustainability and financials, it's the intangibles. So I'll get off my soapbox.
Oh, well done. I enjoy you on the soapbox. Well done. Jeremy, maybe for you also, from working with management accountants, right? What could their role be in this space? How could they pick up the pace on fixing, well, maybe bridging the gap between intangibles and financials, or financials? I don't like the word I don't like the word non-financials, but let's call them that for now, because otherwise we'll confuse the management accountants perhaps. But how could they help?
That's an easy one to answer. So I think management accountants are in a fortunate position within their organizations. I am a management accountant by profession, and my experience of working within the in-house finance and accounting team is that management accountants are very good translators, and they're very good at translating different bits of information about the business's performance and prospects, and helping translate that and apply it with rigor to financial performance and forecasting. They're also very good at decision-making and resource allocation. But if one sees the management accounting team as probably the best translators you have within the organization, they're the ones who are very well positioned to understand the sorts of topics that are being discussed today, which are actually very complex topics around sustainable business models, sustainable resource allocation, sustainable resource consumption, within a systems thinking perspective on the world. That's quite a tall ask of anybody, to be able to interpret that and say, what does that mean for us as a business in terms of our past performance, our current status, our current position, and our future prospects. And I think management accountants are well placed to be able to translate the one into the other. I'm glad you've made raised the point around financial and non-financial, because I think this is, again, I think this is part of coming of age. One sees fewer references to that dichotomy of financial and non-financial, and I'm very glad about that, because the problem with labeling something as non-financial is it gives a get-out-of-jail card to all of your finance and accounting teams to go, oh, it's non-financial, we don't need to worry about it. Whereas actually, I think the way things are positioned now from an EFRAG perspective or an IWSB perspective of, actually, this is sustainability-related financial disclosures, or this is sustainability-related risks, opportunities, and impacts, depending on if one's taking sort of die-hard IWSB view or die-hard EFRAG view, although, of course, with the interoperability between them. That's a really helpful reframing, because then, I think for the management accountant, they can look at information that might previously have been categorized as non-financial and say, oh, okay, this is a risk that needs managing in the way that any other business risk or opportunity or impact might need managing. And this is a sustainability-related financial disclosure. Now, management accountants, again, play an interesting role here. They may not be involved with the production of the external information, but they're certainly involved with the internal information that may never see the light of day in terms of the management report. And again, I think that provides an opportunity for the management accounting team to work through, okay, if we now have access to a richer mix of information through our external reporting in the form of ESRS disclosures or IFRS disclosures, how can we apply what we're learning about the business to our internal management reporting? How can we ensure that management every month through the management pack has access to this information and therefore apply the information to decision making and resource allocation? So in addition to being brilliant translators, management accountants are very good at decision making. And I'm sure any of you from business and industry will have worked frequently with your management accounting teams on resource allocation and decision making. And that's where I think they can play a role as well. So I would suggest it's in those two areas that management accountants have a particular role to play.
Great, and let's invite them to do so and bring them to the table. I'm guessing you're still not a fan of the coin that I phrased once as pre-financial information, which was really frustrating to financial auditors because they really objected against that term, but it brought them to the table, right? So moving from non-financial to pre-financial as kind of sustainability or sustainability-related information being a good indicator for future financial profits or losses.
This argument's been running a long time. I remember having a discussion with colleagues probably in about 2012 about the appropriate use and in fact using pre-financial at that point in time. But it was a novel concept. And I think what it highlighted was that, particularly in the context of a sustainability-related risk, that it may not yet have hit your core financial statements, but it's likely to at some point in the future. And again, I think this is another point of the sort of the growing up pains of what we're all involved with doing, is that we now see the draft guidance that's been issued by the IFRS Foundation around how to connect the sustainability-related risks and opportunities with the financial statements. And I think that's very welcome. I think it's also the hardest thing that any accountant will be asked to do.
We'll leave that discussion for another decade or so. Yeah, Mary, go ahead. Yeah,
just a quick comment. In the prior discussion about intangibles, I was so happy to hear talking about cost of what are you spending on all of these things, and I think that's an incredible opportunity. You know, what we called for, going back to 2010 again, was an intangible capital expenditure report as a management report to begin to learn how to distinguish between today's expense, your current expense, and your investments in the future. And just on a purely learning basis, but the conversation about Roche, looking at, you know, what does it cost to build, I think that that's really what's relevant here. When you make a decision about building a factory, you don't say, well, how much is it going to be worth when we're done? It's going to be, what is the ability of that facility to create product, to drive revenues? What's the cost of it going to be? Intangibles are the same. You're building a capability, and so you need to be able to understand the cost. And everyone often jumps right to the value, to the valuation of them, which you have to do in certain circumstances. But for business people on a day-to-day basis, it's the cost and understanding the implications, and then what are the investments you need to make in the future.
Thank you, Mary. I asked the three of you to also think about an inspiring example in the world of integrated thinking and reporting. And the reason I asked this is because I led the Integrated Thinking and Strategy Group, which is about 40, 50 companies from around the world, just sharing examples of what they did. Also sharing the struggles around, you know, internal politics or getting to the CEO or the CFO and convincing them to do more on integrated thinking or on integrated reporting. But it was really interesting to hear best practices, and I want to inspire the audience just a little bit on some best practices that you have seen in either, well, Lee, let's start with South Africa. There's so many examples coming from your region. What stuck with you as being a, you know, one of those, I don't know, companies or examples that really stood out?
Well, best practice overall, I would say, is to get your board integrated information. So there would be a couple of standing agenda items, as our chair, Mervyn King, always says, and is to make sure that the board is fully informed when governing the company, when making these overall decisions and monitoring, that they have the correct integrated information and complete information, so covering all the inputs on the capitals and all the outcomes and impacts, because that will come back to hurt the company going forward, and the board is responsible for the longevity of the company. Okay, so that said, I asked two of our award-winning integrated reporters for examples, and interestingly, they both gave examples which relate to trade-offs. So in making strategic decisions and considering about the trade-offs, and trade-offs being amongst the 6 capitals. So our award-winning company, Redefined Properties, said that integrated thinking has really helped to better assess and balance value creation, preservation, erosion over multiple timeframes, short, medium, and long term. And it's really helped in making trade-off decisions in a volatile market and in volatile times. And from Nedbank, we heard from Bruce earlier on today, integrated thinking has helped make decisions about digital services that clients want versus effects and impacts on their workforce.
Yeah, so improved decision-making in difficult trade-offs sometimes. Yeah, great. Mary, let's go to any examples that you would like to share.
I would tell folks, I mean, we have a lot of great videos on our Integrated Reporting US Community YouTube channel where we have companies sharing their stories about how they've integrated their reporting, and by extension, you hear how they're done integrated thinking. But I'd like to share a quick story from the work that I've been doing in the last few years since I joined Insight 7. We've been working for the past year with a company called Materna Medical, and it's a company that doing research in the women's health has been a very underfunded and there hasn't been as much work done as there should be for forever. Materna's working in the area of pelvic floor injuries, which are a huge problem for women post-childbirth, that it plagues women their whole lives. So it's been a really interesting laboratory to look at the power of the integrated model and value-centric management for helping this company stand up. They're in their C round. They have $25 million in this round, and they have to move fast to build all of their capitals and obviously prove their product, come to market. So we've been working with them for about a year. What we're doing is creating a level of software that sits on top of all the wonderful tools that they were already using, but so that the team can get together every week and say, how are we doing? What are you doing? What do you need from me? Just a way to get on the same page, because the complexity that they're facing is a complexity that's really common across the world right now. Microsoft says that meetings are up 2 to 3 times since 2020. This company says their meetings are down by that kind of factor. We're gonna be okay. So they're able to make much clearer decisions about what's the value of what we're doing, how do you design your work against that, be able to measure it. They feel that and we've kind of went and analyzed this through key decisions that they have made in the past year, but they say their burn rate is down by 50% by using this kind of mindset. And they're using this, how do we create value for our customers by creating value for our organization, our external stakeholders, the environment. If that's plugged into your daily management, to your planning for your investments in the future, then it's a very, very powerful model. And I tell this story because I want everybody to remember that we believe that integrated thinking and the multi-capital model is so powerful, and we don't want it to be lost in the also very important work of standing up the ability to report reliably on sustainability information. So.
Thank you, Mary. Jeremy, any examples that spring to mind? Not ABN AMRO, a different example, please.
None, no. I was going to say ABN AMRO. Two examples, if I may. One is close to my heart. We formed a partnership with Side Business School at the University of Oxford in order to support capacity building amongst the global accountancy profession around integrated thinking, sustainability accounting, et cetera, and when we were outlining what our first joint course might be with the university, we actually applied the 6 integrated thinking principles to the structure of what we thought the prototype course might be. And it worked brilliantly as an approach. And we've since launched that course, and it's doing really well. So if anybody wants training, it's ESG and Sustainable Financial Strategy course. That's my own direct experience of using it. I think the other company that I want to call out is Unilever. It's a company close to my heart personally. It's a company close to us as an institute. Unilever co-founded CIMA, the Chartered Institute of Management Accountants, after the war, the First World War, in order to support the science and the development of the science of management accountancy during a period of great resource scarcity. And it's also where I was a management trainee. So my understanding of the relationship between business and society, I think, has been very much framed by the early phase of my career that I spent there. And I was just reflecting the number of things over the years that Unilever has done which have really been groundbreaking, going back a long time in the context of what we think of now as integrated thinking. When I was working as a consultant, the very first sustainability accounting team I met was with Unilever. And it's a model that we see more and more of, in which you have very skilled, ambitious technical accountants who are able, as I said earlier, to make that become the translators between the sustainability information and the finance. So they were the first company that I came across that had a sustainability accounting team. The story of when Pullman became CEO and reduced or ended the quarterly earnings forecasts in order to relieve the pressure on the company to be responding to short-term market fluctuations and at the same time to shift the shareholder base was pretty radical at the time, but achieved its end. And the other thing that I remember very clearly, because it was the year that London hosted the Summer Olympics, so 2012, Unilever, I think, was the first company to put a euro value on what the impact of climate change was likely to be on its supply chain. And I don't think any company had done that previously. And it was a large figure. I don't think they expensed it in the P&L, but it was a sort of shot across the bows to the capital markets that this sort of information is relevant. And the figure was in the region of 200 million euros of downside there was likely to be to the supply chain costs of Unilever because of failures down to climate change. And so these are just 3 little examples of where an approach to integrated thinking which contextualizes a business within the relationship it has with the environment and society, as of course the EU Green Deal through the IFRS now encourages or requires companies to think about. I think as a company has been doing that for a long time. So that would be a close second to ABN AMRO.
Oh, thank you. And a great example. Thank you for sharing that, all of you. Are there any questions from the audience? And is there one closer? And one? Just speak up. I'll repeat it if needed. Or do you need I'll repeat it if needed. Oh, the mic is coming, sorry.
Yeah, thank you so much for the presentations and discussions. And sorry, I'm coming back with another question. And a quick congratulations to South Africa and Nigeria for leading on these 2 important aspects for obvious reasons. My question is on the future of integrated reporting in terms of the European market. And I'm asking this question because of the CSRD regulations. More than 82 disclosure requirements and 1,000 data points, how do you see the future of integrated reporting coming into the European market vis-a-vis the demands of these other regulations? Thank you.
Yeah, I think I'll pick that one up because I'm the only one doing integrated reporting in Europe at the moment. It is a challenge. So there's a lot of regulation coming towards European companies, but I think we can learn from others, and that's why I like the space of reporting. It's very public. We can look at each other's reports and learn from each other how they are doing it. I was just talking during the break of someone who had a great idea of really using S1 and S2 to drive integrated reporting, and then I said, well, can we mix in some IFRS standards along the way and still call it an integrated report? I like the commitment of Accountancy Europe. I think Mark just left, but there's Mark. Oh, you're still here. I missed you there. And I think that's also a platform where we can share these examples. And I'm also looking at ISSB to share best practices. And again, to Chiara, is Chiara also still here? Chiara, to share some best practices from EFRAG community to help companies actually achieve this. Because it's very clear from today as well that integrated thinking and integrated reporting is very much alive and is very much fit for purpose. So let's not waste that in the next couple of years. But it will be challenging. So thank you for the question. There was one more question up here. Yeah, thank you.
Yeah, hello. Thank you so much for the panel. Very, very interesting things you tackled there. And yeah, my question would be from the side of the company. We are consulting companies in Kazakhstan in integrating reporting. And the question is that, who do you think, which party needs to be responsible for collecting, updating, and publishing external benchmarks, the industry-specific and country-specific benchmarks in terms of the ESG data points for companies to understand how they can compare themselves with the other companies in the industry or in the country to steer their business in the right way?
That's a big question. Let me see if I understand your question correctly. So you're looking at an entity somewhere in the world to help companies with databases on data points to encourage, yeah, go ahead.
Yeah, you know that the ESG rankings are being criticized because they have very different methodologies, and it's just difficult to understand how to, like, if I would be a business, it's pretty clear in terms of the internal benchmarking, like you should compare within the time periods, for example, being better than the previous period or being better than the, like, if the corporate is consisting of different business units, they need to be comparable between each other. But if a BMW, for example, wants to compare themselves with the other companies in the automotive sector, where should they look at?
Yeah. Okay, so now I understand your question better. So looking at sustainability performance, how to compare one company to the other or a company throughout the years, and who is to say who is doing better, right? That's a big element of your question. So my understanding is from what is happening now with the ISSB is they set a standard, right? So comparability in terms of reporting will increase. But it was already mentioned today that is going to take a couple of years to crystallize and to become clear. Now, I've spent a long time working with ESG rating agencies, and I hope they're not in the room, but they could be here online somewhere. It's you could outperform on Sustainalytics and underperform on DJSI or vice versa. That is very challenging. And I don't think that's going to be fixed in the next couple of years, other than you need to know, what they are measuring, similar to financial performance. Rankings and ratings can agree or disagree. But it will definitely be helpful that we have similar standards and similar data points that we can compare each other to. So I think that is, and management accountants, of course, can help us deliver high quality data. I hope it answers your question partially, but it is, we got two of the biggest questions probably of the day from the audience, so thank you for that. I'm going to wrap up and thank the panel. I had some notes here today. on words that, and of course integrated thinking was mentioned numerous times. I should have counted the number of times, Stefano, that integrated thinking was mentioned, because it's been a great day already on that front. But also wanted to share the 5 C's. That's going to be the new, I don't know if it's going to be a new standard, but it is going to be the new acronym that I'm going to be using, because they were mentioned a lot, and it's not adding to the alphabet soup that Ndidi mentioned, but it's a lot of talk about convergence, about connectivity, about comparability, credibility, and conciseness. And we'll leave it up to the report preparers, and there's a few in the audience, to deliver on this. Thank you very much for listening, and thanks to the great panel.
And now we will have a very short and quick coffee break. Very short and quick, just the time of the coffee, and come back here immediately, because at 4 p.m. we will be here to the final session, please. Thanks so much. integrated reporting. An introductory speech has been planned, but will be transformed into a final speech. And then, at first, we will have the moderator of the speeches, Pietro Poletto, chairman of IAF, Associazione Italiana per l'Analisi Finanziaria, and panelists are Laura Gori, founder and CEO, Waste to Way Global SRL-SB, Shiniki Kishi, General Manager, Sustainability Management Development, Omeya Yasua Life Insurance Company, Francesco Marconi, partner, Arndens in Italia, Marisa Parmigiani, Head of Sustainability Unipol Group, Chair of the Supervisory Board of our foundation. Please, Pietro and the other can be here, and then at the end of the panel, we will have the final speech by Jesus Dabalos.
Hello. Hello, everyone. Thank you so much. I'm Pietro Poletto, the chairman of the Italian Association for Financial Analysis. I'm very... Hello? Hello? Better now. Okay, so I will say I'm Pietro Poletto, the chairman of the Italian Association for Financial Analysis. First of all, I would like to thank Stefano D'Alessandro for inviting us to moderate this panel. So we have a very, very interesting panel right now. And the business and investor case for integrated reporting. Good question. So I would like to start with Marisa Parmigiani, Head of Sustainability at Unipol Group. And let me say a few ideas about your experience. Why an important Italian group listed on the market decided to adopt integrated reporting, and what are the benefits that you have seen after that?
Thank you for your question, Pietro, and thank you to have invited me here in this important contest. We published our first integrated report on 2017 after have adopted the year before, in 2016, our first integrated strategic plan. What we think was that if we were integrated thinking, we should integrated report. So we found coherent to report in one only document the company's performance. Was important for us to have only one place in which can tell our performance and account the coherence between our commitment and our results. What was very interesting for us was also that to design the business model, we have been helped to think about our intangibles. We have spoken a lot about intangibles this afternoon. And for an insurance company, intangible is a key aspect. People don't buy a product, people buy a promise. The trust that people feel toward us is the key aspect for which they buy and come back to buy again our services. So for us to think about intangibles was a key aspect. And another thing was that in our value creation process, innovation had become a key aspect. And in these years, we had just opened 2 new enterprises in the group, one working in UIT, and the other one on big data analysis and computer science. So for us was a way to emphasize our commitment for innovation and the integration of innovation in our core business and in our value creation activity. Designing business model, identify outcomes has been the best process to understand and maximize this role of innovation and technology. I would like to stress this aspect because we strongly believe that technology is a key issue to obtain a sustainable development. This integrated report in these 7 years has been a very useful tool in the relationship with the market. The real stakeholder of integrated report are the financial analysts, the investors, and now that they are always more and more interested in ESG and in innovation, usually start from integrated report to ask more questions and going deeper. Our report is so usually the starting point for at least 2 things. One are the meeting with investors, and the other one are the rating agencies when they evaluate our process and our results. So it has been an effective tool to improve our positioning in ESG.
Thank you, Marisa. Another short question, tricky question. How the big Italian companies are facing the new obligation introduced by CSRD?
Not so well. I mean, I have to disagree with some of the speakers that spoke before than me, because unfortunately, not on its own, but how is going to be used CSRD in the market, the risk is really to transform the integrated thinking in comply with a tick-in-the-box approach to select and use as less is possible data point. The idea is not to represent as better as possible your performance and your commitment, but because everybody is scared about regulation and the penalties that can come with the regulation, the idea is I will say as less as possible, so no one will find something wrong in what I'm telling about. So I hope that after 2 or 3 years, the company could improve their approach on CSRD, looking for a new approach in forward-looking that is part of CSRD, but unfortunately, at the moment, the less considerate.
Thank you, Marisa. So, let's move on to Laura. Laura has a completely different experience, but very interesting, I think. Laura is the founder and CEO of Way to Global, a small company, a small cap in the Italy space, and it's interesting to understand a little more about your business model and the company's focusing in financial reporting translation, if I understand well, and already Laura adopted integrated reporting. So it's interesting I think that in SME space in Italy is quite unique. I know quite well the situation of the Italian SMEs, and honestly, my congratulations, because it's not easy. We are still in a situation not so fantastic in our market, but I think it's encouraging Laura to promote this kind of approach. So please, Laura.
Okay, thank you very much. Thank you. Good afternoon, everyone. And thank you to the organizers as well for having me here, and to Pietro for your insightful question and presentation. At Way2 Global, we specialize in the translation of financial and sustainability reports. And this places us in a privileged position to observe the evolving landscape of corporate reporting. Right now, we are witnessing to a major and exciting shift as the requests we receive to translate sustainability reports are gaining ground on their financial counterparts. So this trend is driven, of course, by the latest European directives and testifies to the growing importance of sustainability in the business world. That said, we at Way2 Global remain a passionate and long-standing practitioner of integrated reporting. And so we keep trusting in its potential to turn into a very gold standard, which is capable of bridging the gap and merging both the financial and sustainability perspective. I believe this is where the fascination of integrated reporting lies, in its ability to capture the very essence of a company and to represent both its financial performance and value creation model on one hand, and its impact on society and the environment on the other. At Way2 Global, we embody this dual perspective and let's say, integrated way of thinking in our business model as a benefit corporation. Despite our small size, we are 13 people with a turnover below 3 million euros. We aim high when it comes to sustainability. We have integrated sustainability in the very fabric of our organization, making it a legal foundation. So for us, sustainability is not a principle, but rather it is a core ethos, which is deeply embedded in our bylaws, in our operations, and in our purpose. Since our inception in 2017, we have been committed to harmonize profit and impact, social impact, positive impact, thus unconsciously anticipating an early concept of double materiality long before it became a mainstream reporting requirement. This radical commitment to sustainability stretches far beyond our own operations. We actively advocate for the benefit corporation model, and we work every day to spread both sustainability culture and sustainability reporting globally as drivers for positive change. So it was the strong convergence between our business model and integrated thinking that triggered my, let's say, insane passion for integrated reporting. We embraced it in 2020 after I certified as a Chief Value Officer and tried to elevate our impact report into a fully fledged integrated report, which is a labor of love that drains the first half of every year and empowers us to champion for the transformative potential and benefits of integrated reporting, even for small enterprises like us. Thank you.
Thank you. Thank you, Laura. I think that I have to invite you to some conference to present to in SME space your enthusiastic approach, because it's very important to share that. So move on. We have a great opportunity now to talk with Shinichi Kishi. Sorry for my Japanese, that is really poor. that is a general manager of sustainability management and development department at Meiji Yasuda Life Insurance. So I think it's important also right now also to understand a little more about the Asian approach and particularly what's happened in Japan, about the recent progress on developing sustainability reporting standard. Please.
Okay. Thank you, Chairman. In Japan, SSBJ, Sustainability Standards Board of Japan, is now finalizing the first set of the sustainability reported financial standards in line with the IFRS S1 and S2 standards in March 2025. So as the consultation period already ended in July, so that we are really in the final stage of the standard development. And the Japanese standards are more or less same as IFRS S1, S1, S2, with a very limited modification to conform them to the Japanese regulations and practices. So I myself have been involved in this standard development process as a member of the advisory council representing the life insurance industry as a group of institutional investors. So I'm generally happy with the current situation of the standard development. And alongside the development of the standards, JFSA, Japanese Financial Service Agency, is currently deliberating with the external expert to register the standard, with a plan to require sustainability disclosure as early as 2027, starting with the globally active companies listed to the prime market in Tokyo Stock Exchange. So in the morning session, the Nigerian case was shared as they're pursuing the kind of one of the early adopter of the IFRS standard. Also, I'm happy that Japan also will be one of the early adopters of the IFRS S1 and S2 standards. And as has been the controversy in Europe and the US, there is some concern, particularly among preparers, about the scope 3 disclosures. I understand that it is very difficult to achieve the same level of the disclosure as scope 1, 2, but I hope some practical solution can be finally found before the timing of the standard implementation. And Japan is the world's largest endorser of the TCFD, constituting 30% of the global total. Also, Japan is also keen on publishing the integrated report with more than 1,000 organizations now publishing the integrated report. So as an institutional investor, we can take advantage of this kind of the proactive disclosure stance of Japanese companies, and thus we can rely on such information. And the issue is in Japan, the integrated reporting is a kind of voluntary activity, not a compulsory action. So the content and the quality of the integrated reporting varies by industry or company by company. So as was raised in the previous session, the comparability is our challenge. But I believe that once we implement the SSBJ standards or IFRS S1 and S1 standard, that will be the major catalyst for the sustainability disclosure in Japan. Thank you.
Thank you, Shinichi. Francesco, from your perspective, as advisor, as a consultant, what are the implications that all the companies with integrated reporting will have to manage with the new obligation introduced by CSRD?
This is working? Yeah, that's better. It's a tricky question, that's why I try to skip it. I think this is a good point about, I mean, the integration between, I mean, the integrated reporting and the CSRD directive. As a practitioner, I mean, we are called to find solutions. It's not easy. I agree with Marisa Parmigiani and their point of view. It could be tough, but we see working with clients different approach. The first one, I mean, it's a dual reporting system. So we are listening also Kishi about, I mean, Japanese standards. So companies are thinking to have one report for global comparability where they can choose and they can put more information because, I mean, the continuity of quality of data is really important for companies that already have integrated reporting in place. But of course, flexibility brings duplication of efforts, costs. It's not so easy. We already discussed about technology and tools. Of course, I mean, the companies need to focus on that, but it's a journey. I mean, it's not so easy. So what we recommend, I mean, in order to understand the impact of CSRD is to have a gap analysis. It's necessary to understand which kind of information should be integrated, which kind of data should be collected, and of course, it's need to have a strategy of harmonization. If we think about the double materiality, the companies need to be active and conscious about that, and they have to work on that. So probably a phased implementation, it could be a solution, so focus on critical aspect and high impact disclosure information, and then have a midterm implementation and integration, of course. Key topic is the SMEs and the approach with SMEs. In Italy, I mean, the risk, I fully agree with Marisa Parmigiani, is to feel that the new CSRD is merely a compliance, and that's a risk for all the efforts that we are all putting, I mean, in ESG implementation and, of course, I mean, in thinking reporting. Thank you.
Thank you. Thank you, Francesco. Let me go back to Laura. But your decision to adopt integrated reporting, because you're planning to go public sometimes in the future?
No. The reason was not that. Maybe in the future, I don't know, not now actually. But, well, like Francesco said, integrated reporting has been for us a journey, a transformative journey, an evolutionary journey. And so I'm pleased also to share a few of the key advantages it has brought us. Well, first of all, it has dramatically enhanced our strategic thinking, while enhancing our decision-making, our risk management, and our long-term planning. And at the same time, it has proven like a perfect fit to convey our complex business narrative through the beloved lens of shared value creation, forward thinking, and this multi-capital holistic approach with a strong focus on the importance of intangible assets. Second, it has greatly enhanced our stakeholder engagement. Beyond fostering our communication and dialogue with all our stakeholders, it has also facilitated virtuous involvement and collaboration, which is part of the mission of benefit corporations. Number three, it has granted us a unique competitive edge, helping us better define our identity and positioning as advocates for sustainability governance in the language industry worldwide. Our business model as a native benefit corporation and our unique proposition championing sustainability governance, and not least our sustainability reporting, have helped us to stand out in the market. And as a consequence, despite our small size, we succeeded in ranking among actually 13th among the top language service providers in Southern Europe in just 7 years, and this while competing with the global giants in our industry. And this attracted also the interest of investors, so private equity firms and venture capitalists who are currently prospecting our industry. Number 4, our commitment to transparency and sustainability has both improved our employer branding and attracted clients who share our same values. And furthermore, our voluntary and early compliance with CSRD requirements opened the doors to value chains of large companies who are obliged to comply, and making sustainability reporting a sort of indirect obligation with an immense value. Number 5, last but not least, our pioneering 2023 report, trying to reconcile integrated reporting with the new VSME standard, coupled with our contribution to EFRAG's effort to develop new standards, positions us at the forefront of innovation in the field of standard setting. So what's the outcome of this story? I think that Way to Global's experience shows that integrated reporting can bring so many advantages, even to small companies, and that it's a company's impact and values that matters more than its size when it comes to effectively reporting. So embracing integrated reporting was not a matter of compliance, but it's rather about adopting a new way of thinking, a new way of doing business, and a new way of creating value. And, well, we all know that integrated reporting won't save our planet, but the underlying sustainability practice indeed will. Thank you.
Thank you, Laura. Laura, in your experience, do you think that the Italian SMEs are ready for this kind of change of mentality?
Well, let's say I'm living among an ecosystem of benefit corporations, which is a sort of maverick case among SMEs. And if I shall answer on the part of benefit corporation, I would say yes, because this is our mission to be sustainable. Otherwise, I would say no, because sometimes we talk to people, to other companies, other SMEs, and they don't even understand what we are doing and what we are telling them. That's it.
Thank you, Laura. Shinichi, Meiji Yasuda Life is one of the biggest insurance company in Japan, and probably one of the oldest, by the way. So could be interesting also to understand a little more about the journey of your company to the sustainability approach.
Thank you. Meiji Yasuda started disclosing the preliminary chart representing the value creation process, which integrates both the economic and social value and their impact. But the concept of the integrated thinking is a bit difficult for the practitioners to understand or to clarify, clearly illustrate our thinking and actions. But we, life insurers, are in a very good position, I think. The life insurance business is a very long-term business, and our philosophy and the missions are consistent with the concept of the sustainability as well as the integrated reporting or integrated thinking. So in fact, Meiji Yasuda is selected as one of the A-list company, the highest rating in the CDP's climate assessment. So we don't have much concern about our own disclosure. Rather, we think our challenge exists outside, surrounding our company. I mean, our investees or our corporate customers. Majors as an institutional investor has had a repeated discussion with a number of our investees regarding sustainability and encourage them to deepen their internal discussion, to take action, as well as to enhance their external disclosures, including the integrated report. We also encourage them to draw out their transition plan towards net zero, so on, so on. And concerning our corporate customers varied from the global player to the mid-sized local players. And the global players have sufficient resource to promote their ESG actions as well as integrated reporting, so on, so on. But local, mid-sized, small company has a very limited resource, so they cannot afford for such kind of ESG promotion or integrated reporting, so on. So in order to support such our mid-sized, small-sized, our corporate customers, Majors launched the ESG scoring service by using LIM and ESG scoring tool developed by the Singapore-based startup. Our ESG scoring service generates a unique ESG scoring report, which allows the even mid-sized enterprises to understand the scores and the recommendations of their efforts in various ESG areas. In addition, we will support such enterprises to strengthen their ESG initiatives by introducing solution providers. Our engagement actions with investees and the corporate customers have just started, but we will continue our commitment towards better sustainability disclosure. To conclude, I believe that the implementation of the new ISSB and SSBJ standard will be a major catalyst and will change the sustainability disclosure scene, not only in Japan, but globally. I mentioned earlier that the concept of integrated thinking is a bit difficult for us to understand, but I believe that implementing the IFRS S1 and S2 standards, which are very good guidance, will bring us closer to the disclosures contemplated by the integrated reporting framework. Thank you.
Thank you. Thank you, Shinichi. Francesco, incorporation by reference introduced by CSRD could offer, let me say, more flexibility in the representation, but also some possible potential critical issue in the standardization with the other international standards. What's your view?
Yeah. Thank you, Pietro. And yeah, I mean, the CSRD introduced the concept of incorporation by reference, which allows companies to reference sustainability information already disclosed in other documents, instead of repeating it in the management report. So it's a good effort, for sure, but cannot be like a mantra, I think. Why? I mean, because it could be very complex, first of all, because if we should be always focused on stakeholder communication. And of course, I mean, stakeholder communication is vital for companies. If all the information are reduced, I mean, by reference in the management report, it could be not so transparent, easy to read, of course, but also I can see also risk of inconsistency because we may have different documentation prepared for our scope, I mean, and for other stakeholders instead of I mean, the mandatory requirements of CSRD. So I think it could be complex, first of all. Then I see also, I mean, some audit and assurance implication, because of course, if we make a reference to other documentation, we should be sure that also the other documents are audited with the same procedure requested by CSRD. So you can imagine it could be very complex, probably expensive. And we listened today that companies are operating in different jurisdictions with different audit procedure. So it could be tricky. And then I see also a change of decision-making process, because following CSRD, I mean, the management report is approved by the board and then by the shareholder general meeting. It means that also the other documentation should be prepared at the same time, be available for the auditors, and again, follow the standard. So yeah, I think it's a good effort, but probably we will need more a global regulatory convergence, I think, in order to push a bit, I mean, the European regulatory that is focused on compliance, also, I mean, on a global view requested by the investors, I think. So it's a good effort, but probably will be not enough.
Not enough. I think that we have to work more. We have a lot of challenges in front of us. I think that we need a pragmatic approach in that space in the interest of investors and the users as well. So happy to take any question, if any, from the audience. If no, I'm happy to invite Jesus Zaballos, the chairman of EFAS, the European Federation of Financial Analyst Societies.
Yes, we have here Jesus Zaballos, president of EFAS. We will talk from here, and then
Hello to everybody. Dear Chairman, Mr. Poletto, dear ISB and ISB chairs and vice chairs, ladies and gentlemen, dear colleagues. To be the last one it's a problem sometimes, but it's not a problem other times. However, mostly of the things that I'm going and I have to prepare, I have prepared in my speech has already been discussed. But in any case, let me give you 10 minutes of a small speech. I try to do my best. You know that I'm from Spain, so I sometimes mix the Spanish and the English, but I will try to do my best. It's not siesta time, so I hope you can resist at least 10 minutes. I will start with a quote. In awareness of our responsibilities as corporate citizens, we define economy, ecology, and social commitment as objectives of equal rank. We seek to retain society's confidence through performance, flexibility, and open communication as we work in pursuit of our overriding corporate goals to create corporate value and generate high value added for the benefit of our stockholders, our employees, and the community in every country in which we operate. This quotation is from a major European chemical company, and it was at the core of its annual report 20 years ago in 2004. Thus, the connection between a company and the capitals, as defined in the integrated reporting framework, although using different labels, were already reported more than 20 years ago. Over the years, the situation has considerably changed. The comprehensive reporting, very limited in the past, in fact, in certain cases, has gone the other way, as it provides more information than needed, and in many instances, the information is not as relevant as investors need, and sometimes we call greenwashing. However, the point that remains open for investors is if the holistic and comprehensive reporting approach, now taken by many companies, provides the necessary material information that adds value to investors to make an investment decisions. In this regard, let me say that for investors, a major milestone was when in August 2022, the IFRS Foundation assumed responsibility for the integrated reporting framework, and when the Value Reporting Foundation was consolidated into the IFRS Foundation. We have a lot of hope riding on this consolidation. We expect at EFAS that the integrating reporting framework can become the North Star for corporate disclosure as the IESB and the ISSB boards jointly assume its responsibility. For investors, integrated reporting already provides material information to understand a company's business, its governance model, the risks and opportunities they face, its dimension, its product lines, and its environmental and social impact, and any other aspects that can affect its ability to create value. In one sentence, the organization's strategic objectives and its resources allocation plans to implement its strategy. I personally think that this point can only be answered where three major aspects of companies are aligned when reporting the capitals. In other words, when the different aspects and elements that contribute to create value in a company are linked. Investors need a clear and a useful interrelation between the so-called financial and sustainability-related financial disclosures, what we refer to as connectivity, but also continuity and consistency in the information, and that the information is material and comparable. Connectivity, this is a really key point for integrating reporting. It has been mentioned on numerous occasions, also today, the linking between financial information and sustainably related financial disclosures is necessary. And let me give you a couple of examples. Accelerated depreciation of certain fixed assets to leave room for a sustainable and more energy efficient assets will be reflected in the balance sheet as well as the CapEx. The company will finance the new asset through borrowing or cash flows. Definitely, there is a connection with the financial statements. A better assessment of labor cost, for instance, due to the increasing cost for training programs. The application of social principle are examples of items not originating directly from the financial information, yet affecting the income statements and therefore with a potential impact on net earnings and valuations. Integrated reporting already facilitates the link between the organization's environmental, social activities and intangible investment and expectations of future performance of risk. Integrated reporting also provides investors with a better understanding of the labor and governance policies of a company. These policies have become a key aspect of an entity's corporate strategy to provide capital markets with a broader, more comprehensive understanding of the potential social impact of an entity's activities. Moreover, the information reported should be material, as if it is quantified, the narrative to explain it should be relevant. The so-called financial materiality of ESG is key to helping investors understand how companies create long-term value. Issues that are not currently reflected in financial statements, but that have a significant impact on them. This will also facilitate comparability, which is another key aspect of corporate reporting for investors. Comparability helps us to better understand the performance of companies and to identify the key players in the economic, social, and environmental transformation that the stakeholders' expectations place on companies. To summarize, the information reported should be balanced while providing material qualitative and quantitative information to permit a comprehensive understanding of a company, which is needed to make an investment decision. And one final observation, the information has to be integrated, not blended or only connected. There is a well-known and very pertinent thematic reference from Ian Fleming's James Bond, shaken, not a star. This will continue to be the true motto of integrated reporting. It appears decisive that the financial and sustainably related financial disclosures are not presented as mixed or only connected. Perhaps the most relevant and essential reason for this is that to this day, incorporating a business sustainability into its evaluation remains unresolved. This elementary and obvious issue, but almost always forgotten, is the elephant in the room. I'm going to do it shortly. While this limitation lasts, and it seems that it will be for a long time, the reporting must be guaranteed, at least, that the data is perfect in quality and quantity, so that each investor can cook into their linking. At no time should this point be forgotten. Today, there is no single academical or regulatory accepted criterion to grade the sustainability of a company. The absence of standardization in ESG is a great weakness, something that ESMA has repeatedly warned about. And reporting must aim to make this weakness more bearable and not aggravate it through an arbitrary mix of information. The objective is integrating reporting of information that allow each user to quantify, based on their own standards, the price to pay for a business, knowing that the price will be integral, because when you buy a company, you do not buy the financial and the sustainability separately, but the integration of both realities. To end, let me say that EFAS, the European Federation of Financial Analysis Societies, just two remarks. We represent more than 20,000 financial analysts and investment professionals in Europe. We are more than 14 countries, national members, European countries in EFAS, and we have more than 25 very proud holders of our diplomas, especially, and I have to say in this room, our 35 ESG analysts, that we have more than 7,000 holders worldwide, and we are doing this training in 54 countries nowadays: Asia, Europe, South America, United States. So let me say that EFAS welcomes all the progress made by the International Accounting Standard Board to define and improve the financial accounting standards, and the work done by the International Standard Sustainability Board to issue the new sustainability standards. Both are a major contribution to the improvement, efficiency, and transparency of capital markets. EFAS has been collaborating for many years with IFRS, and we will be very glad to continue working closely to face the new corporate reporting challenge, including when it comes to demonstrating the value of integrating reporting to investors. Thank you very much.
And now we have the honor and the pleasure to have here with us Takehiko Matsuo, that is Vice Minister for International Affairs, that is METI of Japan, and I invite him to be here to have this speech about corporate value creation.
Thank you, and good afternoon, everyone. Taking this opportunity, I'd like to share with you the progress of our effort to promote integrated reporting and integrated thinking in Japan. And I try to be very brief. I know that you are already very exhausted. Firstly, this chart shows that in Japan, especially in the past 10 years, the number of companies issuing integrated report has been steadily increasing. And the number of the company last year exceeded 1,000, which is more than 10 times the number from a decade ago. And I believe that this shows that both companies and investors has recognized the value of understanding corporate opportunities and risks these companies are facing from the mid-term and long-term perspective. And this is what we want to see, and we Japanese, especially METI, the ministry which is responsible for economy and industry, we are promoting integrated reporting as a tool for companies to develop their long-term, mid-term, long-term strategy in comprehensive manner and refine it through information disclosure and active dialogue with investors and relevant stakeholders. And for the past 10 years, especially, in collaboration with Professor Ito of Hitotsubashi University, we have been examining the ideal nature of corporate management and the corresponding information disclosure. We have issued 3 reports which are called as Ito Review, named after this Professor Ito, and especially Ito Review 2.0, we pointed out the importance of creating corporate value through dialogue with the stakeholders from a mid-term and long-term perspectives. And in the recently released Ito Review 3.0, we emphasize the importance of corporate management that is particularly conscious of sustainability transformation, reflecting the increasing social demand for companies to ensure sustainability transformation, including green transformation to achieve carbon neutrality by 2050. And this chart shows an overview of a guidance for collaborated value creation, which is one of the outcomes of this Ito Review 2.0. I did not go to detail of this guideline, but just I'd like to attract your attention that in this guideline, we emphasized the importance to respect each company's autonomy, and we are emphasizing that each company should consider by themselves the best way to develop their own, the best way to develop their mid-long-term strategy and disclose relevant information and engage in dialogue with relevant stakeholders, including investors. And this slide shows that the performance of Japanese company in capital market is much worse than that of US and European companies. But of course, not all Japanese companies are performing poorly. And just this purple line represents the performance of companies who are leading the efforts over sustainability transformation management, while this blue line is showing the performance of major Japanese companies, including those. As you can see, it's apparent that this performance of this purple line or purple company is much better than blue one. And METI has established the Sustainability Transformation Brand, or SX brand, to highlight such companies who are making efforts to incorporate sustainability transformation management in their strategy. And there are the 15 companies who are selected in a first round of this sustainability transformation brand. And so grouping these leading companies, we expect that we could attract investors' attention to the potential of Japanese advanced companies, and also would you like to encourage other companies to follow this good precedent of leading companies making a good performance? In addition to selecting these companies, we are also releasing the kind of easy to understand summary, which shows initiatives and achievement of these 15 companies, and also held a symposium to share share the experience of these 15 companies as good practices for the consideration of other companies. And fortunately, we have received very positive feedback from participant companies. And as such, in conclusion, through this initiative, we Japanese government has been encouraging Japanese companies to cultivate their ability to conduct integrated thinking as well as integrating reporting. And I'd like to remind you that this year, so finally, we have almost outcome long-lasting deflation, which persisted almost more than 30 years. And now investment is increasing, wages rising, and corporate profit is rising in Japan. So Japanese economy has finally entered a virtuous cycle. And I believe that, I already see that the mindset of business leaders have changed very dramatically. And I do believe that now time has come for Japanese companies to show or put their ability over this integrated thinking, which they cultivated for the past 10 years to work so that they could take a giant leap forward. Thank you very much.
Thank you for this very interesting new presentation about the situation in Japan. And now we have a far-side chart. Integrated thinking and reporting, the future. The Vice Chair of ISSB and IASB, Hugh Lloyd and Linda Mason-Hutter will discuss together about that with a new speech. We expect for you here. Thanks.
Great, thank you. We made it. It's a long day. So we're now going to talk about the future of integrated thinking and integrated reporting. And before doing so, I just wanted to say what a wonderful speech by Matsuo-san, providing a really interesting, I think, case study of a country that has really adopted integrated reporting and integrated thinking, and really showing there the kind of country's business case for why it has done so and the benefits that it is reaping, and a great curtain raiser, because as the curtain closes on this conference, actually we'll be moving to Japan next year for the Integrated Thinking and Reporting Conference. So a great curtain raiser for next year's conference. But let's stick with today and everything that we've heard and learned from our panelists and from our delegates, and think about the future of integrated thinking and integrated reporting. And I often reflect back to a time when I was working at the IIRC 10, 11 years ago, and we often used Victor Hugo's phrase of nothing is more powerful than an idea whose time has come. And it felt sometimes a little bit at that time as though integrated reporting, we were kind of rolling the snowball uphill. You know, sometimes it felt like the ecosystem hadn't quite responded quickly enough to the kind of ideas that we were putting forward. But we are now a decade on, and I think we've heard today from all of our speakers, from the board chairs and yourselves as vice chairs and other board members, and we hear it consistently, how integrated reporting and integrated thinking have become embedded within the IFRS Foundation. So I was wondering, Linda, just if you might kick us off by just thinking and maybe reflecting as well on today's conversations. What is the framework's relevance and usefulness as a corporate reporting tool in your view?
Thanks, Jonathan. It's been a really interesting and enlightening day for me because my background has all been kind of traditional financial reporting, standard setting, various industries when I was in industry. And then this exposure every now and then to the phenomenon of integrated reporting. So instead of, I won't say this is a prediction, but it's an observation based a lot on some of the different views I've heard today. It's clear that everybody in this room believes in integrated reporting and integrated thinking. What I noticed, though, was there seemed to be two views. One is you need to be able to do integrated thinking to produce an integrated report. But Lee said something very interesting, which is, okay, if you can't do that, and it also speaks to maybe smaller entities doing this, then pay attention to what the framework tells you to do. And I think Charles said, if you actually do that, you will learn things about your business that you hadn't really appreciated or observed before. So I was thinking about that in the different countries we have represented in this room, and the different countries that I'm privileged to travel to and talk to stakeholders. And it seems to me that we may be in a position where we have all the right factors for the phenomenon of integrated reporting to come together, whose time has come, right? Because there's no disputing we have a sustainability crisis. There's no disputing, in my humble opinion, that the results of seeing S1 and S2, but also ESRS, are going to make that much more aware to people. But as well, we're going to have a plethora of information, and people are going to have to figure out a framework to consume, to present, and then to allow people to consume this information. And there's really no going back from the sustainability crisis that we have. So it seems to me that perhaps we have the perfect set of conditions to bring the notion of integrated reporting and integrated thinking into the limelight. At least that would be an observation that I think is plausible, in my opinion.
Well, that's great, Linda. Thank you for that. And Sue, we've been talking recently about integrated thinking, and it's come up virtually in the importance of it has come up in virtually every session today. And I was just wondering what your reflections were now on how you would articulate how you see integrated thinking developing, as you've asked us to go away and ask the companies that are adopting the framework to adopt S1 and S2 information within the integrated report. But what do you see? What role do you see for integrated thinking in that process?
Connectivity. So from my side, what I would say, having listened to today, is I found it really, even though I feel a bit tired now, at 5 o'clock on a Friday, the graveyard shift, very energized by what I hear today, because a lot of the time when I'm out talking to people about our new standards and reporting, there's a lot of tired, stressed people who are just feeling overwhelmed. And I'm not saying that there aren't people in the room here who are tired and stressed as well, but I think there's much more an air of positivity. And something I say a lot when I'm walking around is that, we anticipate that there's a really great level of alignment between the stuff that really matters to communicate to investors, to enable them to understand the resilience and the long-term value prospects, value creation prospects for a company, and what really matters for business to really think about to run their business as well for the long-term resilience and sustainability of their businesses. And there's this great synergy between those two things. And I talk about that a lot, and often I've got my standard setting hat on, which I've worn for many, many years, and so I'm thinking about the definition of materiality, information that's reasonably expected to influence an investor's decisions, and I'm working from there. But really what I hear in the room here today is the sort of bottom-up approach that if you're really thinking in an integrated way about managing your business, that's at the heart of what we want people to be thinking about and communicating on when they use our standards and when they do integrated reporting. And so it really reinforces to me the fact that I really believe that we're onto a winning combination here, which is using the integrated thinking idea, using our standards, and using these great concepts that we've inherited from the integrated reporting framework to pull all of that together, well connected to the wonderful financial statements, to really meet needs. And so that integrated thinking really has been reinforced in my mind today as the sort of anchor of everything that we're talking about.
Oh, that's great, Sue. And again, great that Charles is here as chair of the IRCC, because we've also discussed, the four of us, putting integrated thinking on the agenda of the next IRCC meeting. So that's a great way of kind of taking forward today's conversation and having a deeper conversation. So if we think of that as kind of today and where we are and some lessons and insights from the conference, and now looking ahead to what the future might look like when we have more integration and reporting. And what we've heard today is that we've got on the IASB side, the completion of the management commentary project, which it sees as a stepping stone, famously, to further integration and reporting. And we've obviously got the work that we're doing to build S1 and S2 information into integrated reports to see if we can show what that kind of integration in reporting looks like. But Linda, if we were to kind of look over the horizon, because of course both boards have got immediate priorities, if we were to look over the horizon to what this integration in reporting might look like, how would you see, and it's a $64 billion question or whatever, but how do you see the potential pathway to that in the future?
It's a good question, because one of the things I've been thinking about, and not that I want to comment on my age, but I've been a standard setter in one way, shape, or form for 20 years now. Started off as a volunteer member in Canada, became the chair of the board in Canada, and now here as the vice chair of the ISB. Traditional standard setting for a very long time, in my opinion, was very focused on the individual project. I have an accounting issue that I need to fix. So I fix the accounting issue, I do all my due process, and I come up with a solution. If you think about, I remember when I first heard that the IASB and the then vice chair was working on management commentary, I thought, well, that's really interesting. Why are they doing that? Don't securities regulators do that? I mean, what's going on there? And then the more I thought about that, I thought, well, you've got all these components that go into input. Now you're coming out over here and you're thinking about the output. Oh, that's pretty interesting. I like that. So I think that's kind of where we are in terms of my view of standard setting. And so, for instance, one of the big standards we put out this year is IFRS 18, where it tells you much more about how you should structure your performance statement, so you can, have better comparability between entities and things like that. I think we're at a natural pivot point here in terms of what we're doing. And so very much as vice chair, I think more and more not only about the individual projects which we've committed to our stakeholders to getting done, but how do we find the synergies between them, and how do we pace them so that we get ready for the output to be better coordinated? It's still in its infancy as far as I'm concerned. Some of it's still in my head, but I think that's a natural point that we are in terms of an evolution, and I think it's a very good thing.
Yeah, great. Thank you, Linda. And Sue, from an ISSB perspective, I think the kind of early success of the ISSB and the development of the inaugural standards has almost been a catalyst for conversations on integration. People are now saying, well, how does this information come together, fit together, etc. And while the board decided at the beginning of this year that there'd be no specific project now on integration and reporting, I think I'm right in saying that the board didn't say it's not important or that there won't be a project potentially in the future, but that the implementation of S1 and S2 were the priority in the other research projects that I know are starting. So I was just wondering, how do you think this, as we look to the future, how this agenda might evolve in the context of the implementation of S1 and S2, the whole integration and reporting agenda?
Yeah, and I'm glad you asked me this question, because I worry that people think that our decision not to work on a further integration and reporting project now means we don't care, or it's not interesting, or it's not important to us. And if you remember one thing that I said today, remember this: we think that integrated reporting, integration and reporting, the IR framework and integrated thinking are all really super important things. We heard that from our stakeholders in the letters that we got in response to our agenda consultation, loud and clear, that these issues are very, very important issues for financial reporting, corporate reporting. And I think every single board member spoke at our first joint meeting that we had in January and said that thing, that this is a really important project. And I've been also involved in standard setting for about 20 years now, and one of the toughest things you have to do as a standard setter is make prioritization choices. And you have to make prioritization choices, as Andreas was talking about this morning, because otherwise you just don't get stuff done. And it's always hard. For me, it's hard because I love problem solving and that everything's always interesting. But I know that every time we say no, not now, there's going to be somebody who's devastated. And I know that there were many, many probably in this room who really hoped we might make a different choice. But every board member who spoke, who said, this is a really important project, we're going to come to it, it's just not this moment. And for the ISSB, speaking about our perspective for a moment, I think there was two really important reasons for that. One is that people said, look, if you look at what the IFRS Foundation has as resources, we're only just started on sustainability reporting. We really need to build out the specific library on good disclosures to explain how sustainability risks and opportunities are going to affect a company. Great you did S1, great you did S2, but that's the beginning of a journey, and we want you to get on with that journey of setting sustainability disclosure standards. So you need to focus on that. But if I look at the other resources in the foundation, fabulous news. You have the integrated reporting framework already. You've got integrated thinking already. You have management commentary being enhanced. That means that people in the market can use what we have in terms of the standards we've written in combination with the framework and integrated thinking, and you have what you need already to be making good reporting on integrated reporting basis, and to be making progress and to be innovating. One of the things we wanted to do by making a decision to say, not yet, but we're coming, keep an eye on us because it's going to be coming at the right moment in time, is because we thought that there's a lot of innovation in the market. And by having the integrated reporting framework, having our standards, having management commentary and integrated thinking, and by being very careful in S1 not to dictate the presentation of our information, its location, nor how it is pulled together. We just say in the general purpose financial reporting package at the same time as the financial statements and not obscured by other information. Those are the only three things you need to know. Other than that, knock yourself out. It's up to you to decide how to use our standards alongside the financial statements to report in the way that best communicates to the market. And it's really because we had your framework, the IR framework, that we were able to make that decision. And so I really look at it in the positive, and we will be back.
That's very powerful. Thank you, Sue. Great. Applause mid-flow. This is yes, exactly. That's it. So this is the kind of final question to both of you, really, which is, and Sue, you really alluded to it in your last answer, which is kind of what are we asking the market to do now? So we've got the implementation of the standards, we've got the IASB work program, and the finalization of the management commentary project, and this kind of tantalizing prospect of an integration and reporting project at some point in the future, but work to do to implement S1 and S2 within integrated reports. What are we asking, what would be the call to arms, if you like, to the people watching this online, the audience here today, over the next couple of years? What are we asking the companies to be doing in particular? Linda.
So I'll give you what I hope is a very short answer by analogy. I have 2 young grandsons. And if I buy them, I have to buy them the same toys because otherwise they'll beat each other up to play with the toy, okay? So for instance, I buy them little building blocks or Legos or whatever, exactly the same thing. And they come up with very different things using the same tools. And I thought, isn't that fascinating? For me, it's about we've given you, we don't have the perfect set of tools yet. We still have some things to build out, but we're giving you some important things. And they're there and you can see them and you can figure them out. You've got the words. And so what I can't wait to see, and you must feel this way, the first set of statements that you can get your hands on with that incorporates S1 and has S2 disclosures, and I can't wait to see those. I can't wait to see the first things with IFRS 18. I can't wait to see how people use those tools to improve, because then the whole market is going to take off and learn from that, because that's how people learn. It's human behavior. You see something, you go, oh, I did this and this, but look at that. Isn't that interesting? And so for me, that's what I'm anxious to see.
That was a good show of connectivity because you stole some of my thunder in terms of what I was going to say. Yeah, no, often happens. But I'll try and complement. So building on what Emmanuel said this morning, I'd fail as the Vice Chair of the ISSB if I didn't sit here and say I really am looking forward to seeing how you take the package, as Linda said, embrace our ISSB standards as part of that package and show us how you can communicate. I don't want to see compliance reporting about sustainability or using my standards. I want to see communication about what your strategy is for long-term value creation, and I want you to take my standards and make me proud with what you can do with them and get behind them. And if you want to report beyond investors, I'm good with that. You know, the building block approach has been part of the design for the ISSB right from the start. So please feel free to use the IR framework or other tools to complement the information using the ISSB standards to speak to broader stakeholders, but please use my standards well as part of that. The other thing I'm hoping we'll see is this, even though it's not our job to tell people how to run their businesses by any means, I really am hoping that we're going to see more companies saying to us, you know what, when we stop to think about, you know, resources and relationships and impacts and dependencies, when we're thinking about how to report about sustainability risks and opportunities, in the broad sense here, we're talking about the capitals that are in the IR framework. I'm really hoping we're going to hear more and more businesses say, wow, I'm really pleased we did that because now I understand my business better as a residual benefit. And then the last thing I'd say is one of the reasons why we decided to not do more just now is because we're really hoping we're going to see innovation. There's this whole new toolkit that we've been developing together. And we're going to be looking to see, you know, what you can show us, because I think that will provide us with sources of inspiration for how we might develop this sort of corporate reporting framework as we look forward with the two boards very much working together.
Thank you, Sue. Can I just say in conclusion that, and Ndidi referred to this earlier, it is incredibly rare to have a conference where four leaders of both of the boards come and spend time with us and share their thoughts. And Sue and Linda have been with us all day. They've been participating in the panel sessions, and thank you so much for sharing your kind of insights with us today. I think it shows the importance that the leadership of the boards attach to integrated thinking and integrated reporting. And so please join me in showing your appreciation to Sue and Linda. So before handing over to Alessandro, I just wanted to say a few thank yous myself on behalf of the IFRS Foundation. As we all know, these events don't happen by accident. It's the result of quite a small group of people over many months, many late nights, early mornings, long days, planning, organizing, and then executing a conference like this. The IFRS Foundation, as we know, have been partnering with the O.I.B.R. Foundation, and I want to thank the whole O.I.B.R. Foundation for all the support, to you, Alessandro, for being our brilliant MC today. You've kept us to time. Thank you. But I also have to say that while the whole of the O.I.B.R Foundation has been behind our efforts today, there's one person I just wanted to really say a special word about, and that is, of course, Stefano, who has really dedicated so much time, passion, and intelligence to helping us to formulate the agenda today, to helping us to secure the speakers that we have, and this wonderful venue that we're lucky to be in today. So, Stefano, thank you very much indeed for your partnership. And I wondered if you could just come to the floor. It's also Stefano's birthday this week, so I would like to... I spoke about a small, dedicated team, and there are two other people that I've just got to call out and say a huge thanks to, because this conference would genuinely not have happened without them. They say that achievements come from sweat, blood and tears. I think we've avoided the tears mostly over the last few months. I don't know about the blood and the sweat as well, but we've been there. So if I could ask Laura Girella and Antonia Johnson, if she is in the vicinity. Antonia, if you could both come down, please, and accept a small token for all your brilliant work. And with that, I hope to see you all for the drinks, and I'll hand back now to our brilliant MC, Alessandro.
Thanks so much. Thanks so much, Jonathan. So the concluding remarks, what do you expect? That they are brief and concise, isn't it? Yes. And you expect also that I will say a great thank to the IFRS Foundation, and I do. I say a great thanks to the IFRS Foundation here, represented by the top level of the IFRS Foundation. You will expect that I say thanks to our supporters, and yes, I say a great thanks to all those supported our conference, and so you remember them. We presented them at the beginning. And then to the key speakers, to the panelists, to the moderators. It's like that. But I would like to add an additional confession. When I came here this morning, had a huge fear. Because I thought, well, there are a lot of top-level people in a conference, very high level. I've never seen a thing like that in the same conference. So when you have a lot of people or very high level, what is the danger? What is the challenge and the danger that can be? That you have a centrifugal force leading away from the goal of the conference, because each of the people go in different directions, and so you cannot have the effort to reach the goal. But should it have happened, we wouldn't have a very good conference. And the news is that it didn't happen. So this is why, if I pass through the speech we have, I don't want to do it because it's not my task, it's too late now. I perceive that we have not a centrifugal force, but a centripetal force leading into the same goal. And so if I begin with Emmanuel Faber, who said a convergent trajectory, a convergent trajectory. Yes, we perceive that today. And then also Xu, who said at the beginning of his speech that we cannot have really, we cannot understand how to create value for IFRS 1 and IFRS 2 if you don't think to the IR framework. It was a great political discourse, a very important discourse, thinking that we have integrated thinking inside and together with IFRS S1 and S2. So when Andreas spoke about the future of the management commentary, prevented Linda to speak about the same topic after as a chair of the panel. And then after in the panel, I saw that management commentary was strictly linked with business model and with integrated thinking. What had happened? It happened that really this connection was not an idea, an hope, but can be really done. We know we have some problem, yes, because we have the difficulty of small, medium enterprise to enter in these concepts. We have heard by Albano that sometimes, also especially in Italy, we have a law-driven idea about going to sustainability matters, and we have heard also by the regulation authority in Italy that she said, Guglielmina said, I've written that, the climate-related information in Italy is insufficient or inconsistent. Wow. I've seen some handcuffs flying here around, because if the authorities face a thing like that, well, what is happening right now? But if we consider all the speech that we have, and this centripetal force, we undoubtedly think that we can do it. And so we understand that the effort of the IFRS Foundation is to disseminate and to diffuse the new concept. And the fact that the final panel was together with the vice chair and the vice chair of the two boards is enough to understand that. And so if IFRS Foundation wants and has a hope to disseminate and to diffuse the standard and all these concepts, be sure then Stefano and I, that is our O.I.B.R. Foundation, are close to you, and this will be our task, our effort, our engagement. Thanks too much to everybody.